morning. I'm Julie Hyman alongside Brad Smith. This is Yahoo Finance Live, and let's get right to the three things you need to know to start off your morning. First thing you need to know, First Citizens Bank has agreed to buy much of Silicon Valley Bank for a discounted price of $16.5 billion. That includes $119 billion in deposits and $72 billion worth of loans. That's according to the FDIC. SVB's 17 branches will reopen under the First Citizens banner today, and all SVB depositors will switch to First Citizens. The FDIC is going to retain responsibility for $90 billion of SVB's assets that were held in its private bank. And this all comes as Bloomberg reports U.S. regulators are weighing more measures to provide more support for banks like First Republic, including an expanded emergency lending program. Second thing you need to know, investors will be listening closely to the 5 Fed officials set to speak this week. They're looking for any signs of more tightening. On CBS's Face the Nation, Minneapolis Fed President Neil Kashkari warned that the U.S. is closer to a recession amid banking sector stress and a possible credit crunch. And we've got lots of economic data on tap this week. The Fed's key measure of inflation, the PCE, that's due on Friday. Economists are expecting that number to remain elevated. And the third thing you need to know, Twitter is worth less than half of the $44 billion that Elon Musk bought it for last year. As first reported by The Information, Musk said in an internal memo that employees will receive stock grants based on the company's new valuation of $20 billion. In the memo, he voiced optimism about Twitter's path ahead, saying he sees an eventual valuation of $250 billion or higher. But for now, Musk says that the company can be thought of as a, quote, inverse startup as it faces challenges with advertising revenue. Well, First Citizens Bank has agreed to buy a chunk of Silicon Valley Bank for $16.5 billion, according to the FDIC. Those 17 branches of SVB will reopen. They'll be known as, I believe, SVB by First Citizens, and all SVB depositors are going to become First Citizens clients and customers. Prior to this deal, First Citizens had $109 billion in assets and total deposits of around $98 billion. It was the 30th largest bank in the U.S., and obviously it moves up that list now with this deal. Yeah,
pretty instantly. I'm surprised they didn't go with SVB, a First Citizens brand or something like that. But at the end of the day, I think the type of transaction that we're seeing here, it's expected to minimize some of the disruptions for loan customers. That's the good news there. And then the FDIC also estimating that the failure as SVB to their deposit insurance fund, they're expecting that to be approximately $20 billion. I'm tracking a lot of the regional banks here, even in pre-market, the moves significantly higher across the board, plus some additional news around KeyCorp, which you had flagged earlier today as well. And so all of that considered, the regional banks in these extended hours, PacWest even, moving higher by about 10% right now.
Well, and First Citizens itself is up 55% today, and that's because it is getting a lot bigger, and so that is being reflected in the stock price. There were some questions about its ability, this company's ability to take on, because it's 30th largest, right? SVB was something like 16th largest before its collapse, and so there were some questions about its ability to digest these assets and take control of these assets. It's actually made a little bit of a specialty of buying failed banks, right? We should point out to our viewers, SVB, Signature, these are not the first banks to collapse, right? You tend to see on an annual basis a handful of banks that don't make it. They're just not usually very large. Well, First Citizens is one of these banks that has come in and snapped up some of those smaller banks when they have gone under.
Right, and there's a lot for investors to be rewarding and to be happy about, and that's, of course, factored into this pre-market move that you were mentioning, but it was really the size of and the scale of the collapse of Silicon Valley Bank, which, and of course, all of the other kind of tertiary or secondary even impacts that came along with that really caught the attention of the broader banking sector, ensued much of this turmoil and concern, because then it was a larger thought of, okay, if Silicon Valley Bank is exposed to this and there have been such missteps on their front for activities that are quite typical at some banks, but they had so much exposure, and that ran synonymous with some of the other banks that started to collapse thereafter, even within the days and weeks to follow. And so now, even as we're seeing this acquisition take place, we talk about this time and time again, that usually when one of these goes through, the company that makes the acquisition, you see them moving lower, but it's purely a reward of how much they're going to grow out.
How much they're going to grow and at what discount they are buying these assets, right? We saw that with UBS and Credit Suisse as well. And by the way, speaking of UBS and Credit Suisse, Deutsche Bank, which had run into some perhaps concern over its viability on Friday, those shares are rebounding as a bunch of analysts are coming out and supporting it. A couple more things to know as we're watching this banking system concern as it continues to unfold. Bloomberg's reporting that U.S. authorities, regulators are talking about other measures to potentially step in and help the system if need be, including expansion of that emergency lending program that they had talked about. And this follows on some data that we got on Friday. We get it every week, in fact, and it's deposit data from the banks. And it showed the week ended March 15th, we were continuing to see outflows, deposit outflows from the smaller banks and growth from the larger banks. Torsten Slok over at Apollo bringing this chart to us, which shows those small banks and versus the large banks and what has happened. And obviously you see that big drop in deposits. There's been some other reporting out there that some of those outflows have started to slow, right? It's lagging data, weekend in March 15th, but it's something to continue to watch here. And you see borrowing on the part of those small banks, including borrowing from the Federal Reserve, the discount window, et cetera, that's been going up. Some
weekly data that perhaps we'll give a little bit more attention to in these weeks to come as well. Also, U.S. stock futures are trending positive this morning, but there's no guarantee of smooth sailing ahead. Investors, they're bracing for an imminent recession with all eyes on the Fed's key measure of inflation due Friday. Joining us now for an outlook on what's to come is Steve Sosnick, who is the chief strategist over at Interactive Brokers. Steve, thanks so much for joining us this morning and sparing some time here. There's a lot of conversation, of course, even last week about whether or not the banks were doing the Fed's job for them. And given the fact that this is perhaps the most telegraphed recession, as some have called it, that we're heading towards, what should we make of the bank turmoil that's continued to take place and how much that either worsens the projections for a shallow or mild or even severe recession?
Good morning, Brad. This is the problem with banking crises. And I would say, fortunately, it does seem to be relatively constrained so far. But, unfortunately, as we learned in prior crises, these things have a way of metastasizing over time. So as of now, yes, to a certain extent, this does do the Fed some favors in terms of taking some liquidity out of the system, but not in a good way. First of all, you have all this nervousness of bank accounts. Fortunately, not all the bank accounts were wiped out. That would have been extraordinarily deflationary and had terrible knock-on effects. And it will be up to policymakers to figure out what is the right thing to do going forward. But I understand why they did triage when they did. You still had bondholders and stockholders in these companies largely wiped out. And that's a big diminution of of wealth out there, not always equally distributed in that sense, because it's not everyone who holds it. But the other problem you're having is just sort of the gears grinding as people sort of get nervous and move their money from point A to point B. That's kind of a neutral in terms of where the Fed goes. I think it did some of the work for them, but not in the way they want to. It doesn't really attack inflationary expectations. It doesn't. It's the balance sheet. Their balance sheet grew. Even as they're doing quantitative tightening. You can argue it was temporary measures of banks depositing money at the Fed. But it's a very uneven way. And if you ask them if this is the way they want their job done, they will pretty much uniformly say not a chance.
Well, I don't know if there's any ideal when it comes to the Fed, right, in terms of how they want to do their job. We heard from Neil Kashkari speaking yesterday, and he said we are closer to a recession potentially because of everything that's happened. Is that a signal to the markets that the Fed might be done after this? I mean, that's not what the market is pricing in right now.
It's not. And, you still had Bullard last week raising his price target, his peak rate target to about 5 5/8. You still have Kashkari who acknowledges his is around 5 3/8 or something of that nature. So it's not clear that they're ready to call it on inflation yet. This is really the conundrum that markets have. And stock markets, I think, at some level are just sort of choosing to whistle past the negative alternatives. A couple things here. Number one, peak rates do not equal pause. Peak and pause do not equal pivot. We've seen plenty of historical precedents for the Fed raising rates and leaving them there. So there's nothing to say that once this peak rate is reached, whether it's next meeting, the following meeting, or sometime thereafter, that they're going to just turn around and say, okay, yeah, we won on inflation. This is fabulous. Let's just turn around, job done, pat everybody on the back, and start cutting rates. So if you're banking on a rate cut, it's going to have to be for something else. It's going to have to be because of inflation or because of some other recessionary. Because of recession or some other force that forces their hand. And none of those are particularly market friendly. So be very careful what you wish for here. And that's kind of the issue is at what point is the Fed's job done? I think because they left their foot on the accelerator for too long. My guess is they're going to be inclined to leave it on the brake for too long, unless, of course, there's an accident, and you really shouldn't be hoping for that.
So what are the best parts of the market to be in, as the Fed is very clear about making sure that they achieve their dual mandate, but at the same time, investors just trying to figure out how they can best anticipate the Fed's actions?
This is an interesting one because, right now, I see it as almost a generational shift. Is the people who've been through, 2008 and prior, in other words, us older folks, know that these things can unravel in a very, inopportune way and over time. I think that anyone sort of 40 and under has only ever seen a Fed that's willing to just jump in and protect the stock market. Remember, now that's not always actually what the Fed is doing. They're actually, when they do jump in, the quote unquote Fed put, I'll argue has nothing to do with stocks. But the stock market reflects what's going on elsewhere. And so you've either been conditioned to buy every dip because the Fed is going to come to the rescue, or you've seen this movie before and say this doesn't end well. And I think you've got this real push and pull within the markets between two different camps of investors. It's not clear who's right now. Although the one thing that does worry me is sort of the concentration in everybody's favorite stocks, so to speak. You've got now Apple and Microsoft combining to be 25% of the Nasdaq 100. Stop and let that sink in. Two stocks being 25% of a major index. 13% of the S&P 500, give or take, combined. And so I think the idea of just buying, you have to be much more selective and a little more risk averse, I think, than the markets are intending to do. But it doesn't mean you just have to run for the hills either.
Yeah, I mean, Steve, I'm over 40. I remember the financial crisis. I wasn't trading it. I was reporting on it. But, can't there be a way that's neither of those? And I guess that's kind of the scenario you're painting. In other words, is there imminent disaster? Is the banking system going to collapse? Doesn't feel like it. Should you go in here and buy like crazy? Maybe not. But, isn't there a third way, which is kind of what you're describing, that you just go in and kind of pick and choose here?
Well, I think that's it. I think selectivity is important. I think being nimble is important. I think not being wedded to one, to one investment dogma, so to speak, is very important. And that's really the key. But I think you have to back up and say, what are your assumptions? Am I essentially betting on some, 3-team parlay to come through that we won't get a banking crisis and we'll win on inflation and we won't get a recession? Is that, if that's your base case, think about that, because a lot has to go right. If your base case is we won't have a banking crisis and the Fed may back off a little bit and we may get a mild recession, well, that's something different. So just go through your scenarios and put a probability on each of these things. I think right now the banking crisis probability certainly feels a lot less than it was a couple of weeks ago. I think, each of these banks had a specific problem. In the case of Credit Suisse, one that had been building for years. So maybe it won't be as contagious as it was before. We certainly hope not. But I think you have to really think through the scenarios of what do I expect happening? Am I implicitly banking on a good economy? Am I implicitly banking on recession? Am I implicitly banking on investing based on rate cuts? And if so, what's going to cause those rate cuts? So you have to work through all these details, I think, to get to the bottom line of what you should be doing. And that's not necessarily the same thing for every person.
Steve, I certainly hope that you weren't banking on a 3-team parlay after watching March Madness this weekend, because that wasn't it.
I live in Connecticut, so that's been my team.
You're riding high right now. Love it.
All right,
Exactly.
Steve Sosnick, good to see you, Interactive Brokers Chief Strategist. Thanks a lot.
Thank you. Twitter
isn't worth what it used to be. After paying $44 billion for the social media company in October, Elon Musk now values his company at just $20 billion. That's according to a leaked internal email. In that memo, Musk defended the radical changes he's made at Twitter, like layoffs and cost cutting, as necessary to avoid bankruptcy. Massive job cuts since Musk's takeover saw Twitter's headcount drop from 7,500 to less than 2,000 since October. And last month, it was revealed that more than half of the company's top 1,000 advertisers have stopped spending on the platform since Musk bought the company. Ads were initially responsible for more than 90% of Twitter's revenue. Of course, Musk has tried to pivot it more to subscriptions. Dan Halley is going to join us later to explain what this latest news means for the future of the social media app. Well, as U.S. consumers are remaining calm despite that ongoing banking crisis coupled with rising rates and high inflation, this is causing CEOs to be suspiciously optimistic as demand trends remaining strong, Brad.
That's right. And you can read all about that in today's morning brief that's written by Brian Sozzi up on the Yahoo Finance homepage. Sozzi is going to be interviewed with executives, retailers such as Pinterest, Chewy, Foot Locker, and Ulta. That's later today to discuss how long all of this economic resilience can last. For more on this, we welcome in Joe Bruce-Willis, who is the RSM chief economist. Joe, great to have you here with us this morning to really help dive into some of this. What do you think CEOs are so optimistic about right now? If you were to kind of put a pin on anything.
Well, right now, CEOs are seeing economic data and purchase flows that really reflect what was going on prior to the financial crisis. And what I see in the economy is we're going to see a first quarter growth around 2 to 2.5%. Inflation remains elevated, but it is easing. And consumers haven't quite yet finished their experiential spending demand. They haven't quite spent that yet. So they're getting out, they're traveling, they're eating at restaurants. Things are moving along. However, there will be a lagged impact as tighter lending means a slower business expansion and, of course, less hiring. But that's going to be a second half of 2023 story.
Well, and when you talk about tighter lending standards, Joe, you're looking at financial conditions. I guess everybody has their own flavor of financial conditions indices. You have yours over at RSM, and it is showing a tightening there. So what are the implications of that in terms of, as you're talking about how it's going to play out in the second half? How does the rest of this half look, and then the transition?
All right, so 3 weeks ago, our financial conditions index was just below neutral, right? Now it's 1.7 standard deviations below neutral. That's a significant move. Anything beyond 2, you've got a severe crisis. What that means is that when we get the next round of data, the Federal Reserve's Senior Loan Officer Survey, what you'll see is a noticeable tightening of credit beyond the corporate sector, and it will be aimed directly at the household. That means mortgages, credit cards, and auto loans and personal loans are going to be much more difficult to get. Even individuals who want to get home equity lines of credit will run into a little bit of problem, and that overall will just cause overall consumption to slow. You'll see it in the second quarter, but I think by the time we get into the second half of the year, which is where our baseline since late last year is the second half recession, that's when we'll likely see it, but not quite yet.
And so baseline recession, second half of the year, but we've heard some of the calculus around a shift from either shallow to mild or even mild to more severe. Where would you kind of put that base case at right now?
Well, right now we're still in the mild camp. You asked a really good question for your previous guest. And it revolved around, hey, our financial condition is tightening to the point that it's doing its job for the Fed. Okay, well, a couple of things on that. We modeled that, right? We modeled that impulse shock that hit the economy via the financial channel. We think it's worth about 50 basis points of policy tightening. So right now, in our estimation, the proxy federal funds rate, the top's around 5.5%. That's very restrictive, Brad, right? So that's going to show up. Now, this isn't what you want to happen. You don't want a disorderly unwind in the banking sector result in a drop in inflation. That's not what the Fed wants, but it's the economy they're going to have to make policy around, which is why I think we're probably going to see one more rate hike if we don't see any significant issues in the community and regional banks going forward, and as long as there's not a problem at Deutsche Bank or there's contagion spread into the American systemically important financial institutions.
So I guess to go back to the original question is, as Brian Sozzi sort of laid out, is the economy resilient right now? I mean, it sounds like maybe it is, but then it's not going, eventually we're going to see more cracks here.
Well, no, Julie, you're spot on there. Before the banking crisis broke out, the R word we needed to be talking about was resilience, not recession. But unfortunately, the banking crisis did erupt. Financial conditions tightened noticeably, and we'll see that later this year. But for now, the appetite to spend is still very strong in the household. They really are out there traveling. They're out experiencing the world, which they missed out on for 2.5 to 3 years because of the pandemic. So we're not quite through that yet. Now, I got to tell you, I've been traveling around the country the last couple of weeks. The airplanes are full. The airports are exceptionally full. And you can tell the consumer's not quite yet done.
And so for the consumer as well, and you do such a great job on jobs days when we have these discussions as well, pairing what we're seeing with employment with how people are still spending. When we think about the goods spending, it seems like in the discretionary categories, there has been some continued weakness there. Are we starting to see that come back, or is it still largely just focused so much on services spending among consumers right now?
Well, I think that the switch from outlays on goods to services has been clearly noticeable. I don't quite yet think we've hit the bottom yet on where spending is going to level off on goods. But as you just get out and you venture out of your home or your apartment, you can see people are out experiencing life. That's a good thing. As long as the consumer is in the game, which I think the consumer will be in the game, the slowdown will be a near miss or just a very mild recession. And that's why I'm in that camp.
Well, fingers crossed. Joe Brusuelas, RSM Chief Economist. Great to see you as always. Thank you.
Thank you.
Coming up, it doesn't always take much for a stock to move. Sometimes you just need a positive sign. Alibaba investors got that with the sighting of billionaire Jack Ma in China after months of absence. We're going to discuss what that could mean next. We're a few minutes from the opening bell. Let's take a look at some movers. You see Pinterest there. The share's getting a boost in pre-market trading after UBS upgraded the stock from neutral to buy and cited more confidence in the likelihood of execution under the company's new CEO here, and saying that the company is being pushed to unlock untapped advertising opportunities by that new management team.
It's all about the ads. That's how they're going to create more margin-driven revenue here. They said that the advertisers tell us Pinterest is taking bolder steps and moving more rapidly under its new CEO, Bill Reedy, which gives us more confidence in the likelihood of execution overall. That in the note to clients. Pinterest, for what it's worth, I think in the way that they're looking to make the platform more shoppable, how they're really integrating more advertisements. At the end of the day, it'll come down to on what user base, but I think on the strategies to just make sure that they've got enough referral traffic that continues to come through and leveraging how often, I at least on my own anecdata, see Pinterest as the number 1 or 2 ranked option in Google search rankings or in just my preliminary searches. I think Pinterest is doing good from that perspective. And the positive feedback from advertisers, I think, solid enough for one of the key analysts here to really give the rest of the street the kind of the warning sign, or not a warning sign, but perhaps vote of confidence moving forward from here. The heads up, yeah.
Yeah, it's interesting. You talk specifically about the amount that the opportunity here in dollar terms, the analyst, I mean, at UBS, saying that the company in particular is focusing on international and that a ramp up of international advertising could add $500 million to the company's revenue if it shows similar patterns that it has shown in new markets in the past. So that would obviously be significant for Pinterest. So we'll be watching that to see if there is that execution that he is waiting for.
Right, and getting more on at the same time that they're seeing more ad revenue come through, continuing to increase one metric that has been core to Pinterest since the moment that they went public, and even prior to that, which is the average revenue per user, and internationally seeing more of a spend that actually goes their way as well. That's been key to them.
And one more fun thing. Bill Ready's going to be on with Brian Sozzi at 4 p.m. today. Soz is out at Shop Talk in Las Vegas, which is a big consumer and retail conference, and he's going to be talking to him there. So we'll hear from the man himself what some of his plans are.
There we go. Big conversation coming up, everyone. Also, we got to talk about shares of Roku. They're rising today after the streamer got an upgrade from Susquehanna Financial to positive from neutral, citing attractive risk rewards and positive long-term opportunities. You were taking a look at shares here pre-market. They are holding on to some gains right now. And for Roku, I mean, I don't know how often I have not logged back into a Roku since, my gosh, like 2 years now. I don't know. I changed over my TV. I just haven't used it. So I don't know what's on there anymore.
Do I use Roku? Sometimes maybe we use Roku to access certain channels.
Well, it's a hub, right? So yeah. I mean, similar to your usage, I guess it really just comes down to how many of those different streaming services they were able to keep on their hub, as many of them were saying, you know what? We don't know that we need you to be the access point or the sole access point, especially as we're building out our own kind of user experience. And for that, you would want to insulate it in the data that you're taking on versus what you're passing on to a Roku instead.
Yeah, I mean, this is a good reminder. I need to do some organization, some house cleaning of my streaming.
Clean up your algorithm?
Yeah, something like that. One more interesting note that Shyam Patel mentions, the Susquehanna analyst, there's no balance sheet risk from Silicon Valley Bank, right? Roku is one of the publicly traded companies, I think the biggest.
One of the largest
that had exposure to SVB because of its banking relationship with the company, but then in theory, got all of its money out of there, recouped all of its deposits. So the analysts there just emphasizing that it's not an issue.
Nobody's asking about the Quibi content on Roku anymore. I mean, remember when that was all the rage?
Does that still exist?
Well, they licensed a bunch of the content as Roku was trying to ramp up their own original content offerings too.
Yeah, I don't know.
Nobody asks about that anymore.
I'm not confused as to why.
I'm going to look into it.
Yeah. We're coming up on the opening bell on Wall Street on this Monday. Our markets check here sponsored by Tasty Trade as we get that opening bell. And we are looking maybe for a little stabilization here in the markets. We shall see. We are looking at a higher open here this morning. And look, there's Con Ed ringing the opening bell here in New York City, with some hard hats to boot.
Don't tell them where I'm at.
So if we take a look at how stocks are opening up here this morning, we are looking at some gains here. So again, are we going to see stabilization? There is not yet a big expected market catalyst until Friday's PCE report, but there could always be unexpected catalysts, of course, as we continue to watch the banks in the wake of First Citizens buying of many of SVB's assets. The Dow, the S&P, and the Nasdaq all trading higher today. The Dow coming back the most. It's more heavily weighted towards some of the large cap banks. So maybe that's what's going on there, Brad.
Yeah, taking a look at the major averages out of the gate, as you mentioned, across the board, we are higher. The Dow Jones Industrial Average up by about 0.8% right now. Early in today's session, just about 45, 50 seconds into it. The Dow, we'll populate this chart for you, give you a 5-day look, just so you can see some of the context with which we come into this week on and a little bit of last week's activity. So with today's move higher over the past 5 days, a net positive, the Nasdaq Composite, as of right now, you're seeing that higher by about 0.4%. And then additionally, over the past 5 days, still holding on to some net gains there. The S&P 500, that too, in positive territory, up by about 0.6% early in trade, up by about 1.1% past 5-day period there since we were giving you a look at that. I want to take a look at a few things. First and foremost, as we always do, we'll give you a look at the 11 S&P 500 sectors. We've got them pulled up here for you on the screen. We've really only got one laggard here at the gate this morning. That is communication services, down by about 0.3%, pulling up the caboose. But XLF financials, yeah, that's higher by about 1.7, 1.8% right now. Speaking of financials, we'll take a look at some of the regional banks, and then we'll take a broader look at some of the big banks here. Regional banks, not a red dot or square to be found right now. And if we were just kind of ranking this in terms of the move on the day, of course, one of the biggest moves that we're seeing there, First Republic Bank, up by about 28%, of course, off of continued movement that we're seeing in terms of the ability for some consolidation to take place, but hopefully some improvement in sentiment and making sure the customers and the loans are secured as well right now. But then additionally, taking a look at the larger banks as well on the day, you're seeing green on the screen there across the board. One of the biggest movers that I'd seen pre-market was, well, another quasi-regional bank, if you will, PNC, expanding though, just a little bit more to my surprise. My own hometown bank growing up, but well, not so much hometown, but anyway, home state. Truist Financial, that's up by about 6.25% here on the day.
Yeah, do you have Key Corp on that full?
You know, that's a great question.
I don't see Key Corp. It would be Key if it was there.
Yeah.
It could be on the other one potentially.
Yeah, let me toggle back over to that.
In any case, there it is. It's upper left. Key Corp up 8% here this morning. Got upgraded over at Citi along with M&T Bank. Interesting there, Citi analysts are basically saying we're not waiting for the feds to do more stress testing. We're going to do our own stress testing.
Yeah.
So they did it of the regional banks, and they said in particular for Key Corp and for M&T Bank that the risk reward looks very appealing here at these levels.
Yeah, they also had mentioned that M&T Bank was the most disciplined with its excess cash during period of low rates, strongest capital position as well of the regionals, and then went on to say Key Corp made some mistakes, but these are near-term headwinds, and the bank is set to benefit from the repricing of rate assets as well.
Yeah, interesting stuff. So we're going to keep an eye on those banks. We are also going to keep an eye on Carnival Cruise Lines. That's because the company came out with its numbers. The cruise giant reporting earnings for the first quarter, and the shares are trading 3%, up 3% on the back of that. It looks like that the loss is coming in more narrow than expected. A loss per share of 55 cents, 60 cents is what analysts had been predicting here, and revenue coming in at $4.43 billion. That is also above what analysts had been anticipating here. So I'm just looking at some of the other metrics here. Occupancy at 91% at this point, as they carried 2.7 million passengers in the quarter.
Yeah, and on that figure, the revenue in the first quarter, that represented about 95% of 2019 levels. Of course, that's a continued kind of marker that you get across the travel and accommodation space as they're either trying to return to full capacity or just make sure that they're bringing back in customers to reach or reestablish or just reassume some of those financial positions from back then, either on the profitability side or just more generally on the margin side. For Carnival, that's meant they have to roll out re-engagement campaigns on the marketing side. That's meant that they have to figure out, all right, where do we also need to make more investments in our fleet? That's also been a continued kind of vessel portfolio look across that many of the different, whether it's Carnival, whether it's Norwegian or Royal Caribbean, whatever, however you're pronouncing them, call them all looking across their fleets, trying to figure out, all right, where do we kind of upscale this experience? And within that experience, ensuring that they're also seeing a higher ticket, and how they look at the ticket is essentially how much a customer is spending through their holistic trip while they're on that voyage.
Yeah, two other things that stuck out to me from the release here. One, the company CEO says there's no plans to sell equity to raise additional cash. And two, the strong performance extended into March. So still seeing strong trends. You know, we were just talking with Joe Bruce-Willis about when the consumer might start to roll over. He was talking anecdotally about seeing very full airports across the country. Yeah. So this is another anecdotal indicator that people are still out there spending on travel.
They're out there ready to get on the high seas.
Yeah.
Set sail. All right, coming up, the stock yo-yo. Jack Ma's appearance in China caused Alibaba's shares to rocket on just the sight of the man. Then investors got spooked and we lost all those gains. So what happened? Jared Blickery is going to break it down for us next. Welcome back to Yahoo Finance Live this morning. Let's take a look at the major averages here as we are green across the screen to start off a fresh week and the final trading week of March and of the quarter here. For more, let's get to Jared Blickery at the Wi-Fi Interactive. Jared?
Right, we're going to get some monthly candlesticks at the end of the month, but for today, we're seeing a little bit of green on the board. S&P 500 up 0.5%, Nasdaq up a little bit less than that, and the Dow is leading the way up 0.6%. By the way, this is a flip-flop from what has happened typically this year. That would be the Nasdaq leading, and is more of a reflection of what was happening last year, a Dow leading market. So let's see what brings of this. But right now, financials really leading the way. That's giving the Dow a little bit more heft right right now. It has more exposure to the financial and the traditional healthcare sector than the Nasdaq if you scratch out biotech. Staples also in the forefront here, utilities, consumer discretionary, industrials, all rounding out the top row. Tech and communication services, those that what you would see in the Nasdaq 100 and some of those mega caps, those are down, but just only slightly right now. And I do want to focus on some of our leaders here. And KRE, Brad was just taking a look at the banking sector and the regional banks with the latest divestiture, or sale, I should say, of those SVB assets. Finally, KRE up 2.5%. ARC, the disruption ETF, that's up 1%. To the downside, Chinese stocks are down 2%. Had some interesting news overnight with respect to China. First, industrial profits for January and February, that sank by about, what was it? I forget the exact number, but by a considerable amount versus last year. That was not a huge surprise, but also Jack Ma surfaced in China. Now, Jack Ma has a very storied story with respect to the Chinese authorities going back to 2020. That was when Ant Financial, a subsidiary or affiliate of Alibaba, was supposed to go public. Jack Ma disappeared. There were a lot of rumors surrounding his disappearance there. And then the next year, Didi went public, unrelated company to Baba, but that was a terrible IPO for U.S. investors. So all in all, been a really interesting development there with respect to China. You can see most of these shares in the red right now. There was a brief pop when that Alibaba Jack Ma news surfaced, but I have to move on to crypto real quickly. We're seeing Bitcoin easing off that 28,000 level. We've seen some positive developments with respect to price action here. On a 3-year chart, you can see still on the very low end of this range, but importantly, we do have a series of higher highs, higher lows, and we are in a short and medium-term uptrend here, guys.
All right. We'll see if that remains intact. Thanks so much. Appreciate it. Coming up, pricing and risk. Crude oil getting a boost this morning amid plans from Russian President Vladimir Putin to place tactical nuclear weapons in Belarus. Is this the next leg higher? We'll take a closer look next. Crude oil has been reacting to the turmoil in financial markets as of late, and prices rebounding slightly today as investors digest comments from Russian President Vladimir Putin over stationing nuclear weapons in Belarus. That's seemingly outweighing weaker data out of China. Let's get a sense of the direction from here with Paul Sankey, research lead analyst. Paul, it's good to see you. I mean, we're still seeing prices that are way below where they were. We've seen the trend remain lower. Do you think it stays that way, though?
Well, it was really, as you said, a financially driven price drop. So it was the regional banking crisis that really took the air out of crude, basically because risk off saw financial flows come right out of crude. There's still an uncertainty about the extent to which the regional banks will cause a major economic slowdown. We certainly have some major clients who are very concerned that the importance of regional banks to the growth drivers of the US economy is going to be very significant. So that's that. On the other hand, refining margins have stayed pretty high, which is really a good indicator that demand remains strong. And so we would expect crude to recover somewhat here, but perhaps stay under pressure from the economic outlook.
From those clients that you're hearing from, are they initiating any type of pivot in their own strategy?
No, they're just saying that whilst they remain, and it's the old story, whilst they remain bullish oil long term, because there's such grave supply problems and such huge population globally and demand globally, at the same time, they really see the regional banks as hugely important to US GDP. And there's going to be a huge tightening in standards, lending standards, that's essentially going to cause a major slowdown. And the specific example they cited was actually in Texas.
So that would seem to point to dynamics that are good for oil prices if we're going to see maybe not as much investment in drilling activity. What is that going to mean, though, for the companies themselves, right? If you can't borrow as much to drill as much, to produce as much oil, maybe it's not as great dynamics for the oil companies.
We don't really see it having an effect on oil supply, actually, the regional bank crisis, because the oils have paid down so much debt. And their activity is within their cash flows, even at this lower price. So others have been saying, this Silicon Valley Bank could have a major effect on investment in the Permian, and we just don't see it at all. The balance sheets are in awesome shape, and they're going to keep the activity up. So it's not a particularly bullish outlook at the moment based on the regional bank crisis.
Paul, we're almost a year removed between the partnership that kind of initiated following the Russian invasion of Ukraine between Russia and China, and particularly on oil imports and exports there. What most notably has been kind of the, any development on that front that is also another impact, net impact to the broader kind of oil market here?
Well, that's been the key, I think, apart from the regional bank, the small matter of the regional banking crisis. That's been the key, which has been, number one, the extent to which China recovers and how rapidly. And number two, the fact that Russia really hasn't interrupted crude exports anything like to the extent that the bulls would have anticipated by this time. So, a year ago, maybe 6 months ago, you thought that Russian exports, particularly of crude, would be down hard. That really hasn't happened. It's had a strange effect on the oil product market because a lot of the crude is being exported to India and China, which are then refining it and in some cases exporting their own products. So the product market has stayed under some pressure. But then we've had this French refining strike, which has taken out 1 million barrels a day of refining capacity. And so that's kept the refining market quite tight. So there's numerous things going on, but one of them hasn't been much lower Russian volumes in the way that we anticipated. And that's probably been the single biggest bear point that we've had over the past month or so.
And do you expect any change to those dynamics with regard to Russia in particular?
Yeah, sure. Over time, Russian inventories are rising, and that over time is going to cause them more and more problems, essentially. And exporting products, especially from the north, is very difficult for them because you're trying to replace pipelines with tankers that can only get into relatively small ports. So there's definitely an issue with Russian exports, and they are likely to decline over time. So most people are very bullish on the second half of the year. They see Chinese aviation, Chinese economy strength combined with weaker Russian supply, no growth in the US supply, all contributing to what could be a very strong second half.
Is there a significant action that you expect OPEC to take in the second half of the year?
been a bit of a mystery because, of course, they announced a 2 million cut, which was a shock, but it was more of a message to the Biden administration than any real effect on exports. So that was another head fake that the oil market had to face, was they said they'd cut 2 million and they kind of didn't, especially on the export side. And now there's no meeting until June. However, everyone's agreed that Saudi wants a price closer to 95, whereas we're at more like 75 right now. So the expectation is they'll do something. Having said that, there's tension we understand, within the OPEC between Saudi and UAE as to whether or not we want higher price for less volume or just more volume in the case of UAE. And that's an interesting tension to watch. But for now, there's no meeting till June.
We'll be watching it. Thanks so much, Paul. Good to catch up with you. Sankey Research Lead Analyst Paul Sankey. Thank you.
Thank you.
Before we head to break, a trending ticker you should keep an eye on: shares of Germany's BioNTech slumping as it forecasts a worse than expected drop in its revenue this year amid drying up demand for COVID vaccines. The group partnered up with Pfizer, remember, for its pandemic shot, but it's now warning revenue from COVID vaccines could drop to around 5 billion euros in 2023. The shares are down 4%. We'll be right back. Federal regulators are set to testify before the House Financial Services Committee tomorrow about the collapse of Silicon Valley Bank and Signature Bank. Straight ahead, we'll recap all the recent bank chaos and look ahead to that hearing with Gillian Tett of the Financial Times and the American banker's John Heltman. Stay tuned for that. We want to know what regulation could come as a result of all of this. We'll be right back.
SVB hearing,
major economic data,
and some heavy hitters reporting earnings.
It is a busy week in the markets. Here's what you need to know. For the first time, members of Congress will grill top banking regulators over the collapse of Silicon Valley Bank and Signature Bank. Expect leaders from the Fed, FDIC, and Treasury Department to testify on Tuesday and Wednesday as lawmakers try to get to the bottom of why the banks failed. Wall Street will be watching this week for the latest round of economic data. How is the overall economy doing? We'll find out with the latest GDP report, along with inflation and housing numbers. And big-time market movers Walgreens, Carnival Cruise Line, and Lululemon are primed to post their quarterly earnings. We'll get a good look at the consumer with these reports. Yahoo Finance will break down all of these stories.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. It is Tuesday, March 27th. Let's check in with what's going on with the markets. We've got all three major averages in the green today. Not runaway gains, but still a little bit of a bounce back here. And I'm watching our trending tickers because guess what is on those trending tickers? Again, from YahooFinance.com. It's the banks again. First Citizens Bank shares number one with a bullet there after the company agreeing to buy most of the assets of Silicon Valley Bank at a discounted price of $16.5 billion. It makes the bank a lot bigger as a result, and that seems to be why the stock is higher, in addition to getting those assets at a discount. Then we've got Silvergate Capital somehow is still on here as well. And SVB Financial, even though we know that one's not trading, it's still on the trending ticker page. In other words, people are still looking at the news from these guys, even as they are not moving any longer. First Republic is up by 16% today. That one is still live and still moving, coming down from its highs of the session. Another way to slice and dice all of this is to look at our heat map of the regional banks and where we are seeing them today. Indeed, we see them mostly green on the screen on a combination of that deal getting done, some reporting over the weekend that regulators are willing to step in with a little more support for the banks, in addition to some comments by Janet Yellen late in the week last week. Large banks are also doing well in today's session, mostly for the most part. And if we look at the sectors, which Brad did a little bit earlier, all of the sectors in the green today and financials, not surprisingly, are leading those gains. So banks hoping to ride the Wall Street recovery here today as we are watching all of this news. First Citizens buying the remnants of Silicon Valley Bank, or at least some of the remnants. Regulators playing a key role in calming markets by promising coverage, perhaps, of uninsured deposits, not explicitly. But did regulators help stave off the worst of the crisis, or did they increase risk-taking at banks? There's going to be a hearing on that front tomorrow in Congress. And to talk more about that is John Heltman, American banker, Washington bureau chief, and Jillian Tetz with us once again, editorial board chair and editor-at-large for the U.S. at the Financial Times. Thanks to you both for being here. Appreciate it. Jillian, I want to start with you here as we get news of this deal, First Citizens buying some of those assets of Silicon Valley Bank. Where are we in this crisis, right? What does that deal tell us about where we are and maybe how much further we have to go?
Well, what it shows is that the FDIC playbook of looking at when a bank fails, taking it over and trying to sell it to another bank to promote consolidation in the sector, that is alive and well, and that's absolutely what the US regulators are trying to do. And, kudos to them for actually trying to get a deal done. Now, what's very interesting is that they couldn't do this deal, 2 weeks ago when Silicon Valley Bank was going down, partly because the speed at which the markets reacted, the first big bank run on Twitter and Slack, if you like, simply overwhelmed the regulators and gave them no time to craft a solution or carry out an auction in a normal way. And so one of the really interesting questions going forward is that, yes, it does seem that like the worst of the panic around the banks is easing. Yes, it seems as if the regulators are starting to get more in control of the situation at long last. But why on earth did it take them such a long time to do this? And what kind of shifts in the regulatory regime will they need going forward, given that we're dealing with a system which is basically plagued by two addictions, an addiction to easy money in the last 10, 15 years, and an addiction to digital technology that has changed the way that bank runs occur and changed the way that people communicate, and panic can erupt.
John, how do we ensure that this hearing doesn't become just another element of political theater and that there are questions for the everyday American, all the way from someone who just has money deposited with one of these banks to the larger businesses, perhaps, that rely on the financial services that these banks have offered as well?
Well, I'm not sure that there is any way to make this not devolve into political theater. I think that's somewhat baked into the assumptions here. But I think that the way that things have settled down, it seems, is that Republicans have kind of identified their line of questioning as around what did the regulators know, when did they know, and why didn't they do more to keep this from happening in the first place? Whereas Democrats seem to be congealing around, see this as proof that Congress's rollback of certain aspects of Dodd-Frank in 2018 was a mistake. Both of those things can be true at the same time, but what will be interesting to me is seeing what certain members of the Senate Banking Committee, specifically, I'm thinking of John Tester, who's up for re-election in 2024. I'm interested in seeing what he's going to say and whether he sounds more like the Republican or the Democratic line of questioning and attack.
And I guess, Jillian, then the question is, in the old saw goes, you're always sort of litigating the last crisis and not looking ahead to the next one. So probably mistakes will be made this time around as they look at how to fix what happened. But what do you think sort of the most likely outcome is of all of this from a regulatory standpoint?
Well, one of the key issues that caused this crisis is that too many investors, and it seems regulators, have been fighting the last war. And the 2008 financial crisis was very much focused on credit losses, the fact that mortgages went bad. And people have been looking at credit issues in the last dozen years and strengthened the bank's capital reserves to absorb more credit losses, loans going bad. What caused the crisis this time, though, wasn't credit losses. It was actually interest rate problems on the balance sheet because Silicon Valley Bank had not prepared for the rise in interest rates properly. And that raises two questions. Firstly, subsequent to Silicon Valley's collapse, we've heard that some of the regulators were indeed looking at Silicon Valley Bank. But one big question is, if they were supervising Silicon Valley Bank, why on earth didn't that message get to the very top of the Fed? Why was nothing done in time to stop it imploding? Secondly, what other institutions had these big wrong way interest rate bets? Because many parts of the financial system, like insurance companies, have been essentially exposed far too long to the idea of easy money staying in place. And so people should be looking at insurance companies, private equity companies, and asking whether they're properly hedged. Thirdly, are there going to be new credit losses coming along as we begin to go into recession? I mean, commercial real estate is the sector people are watching very carefully right now. And fourthly, the really big question is, do the regulators have the right regime in place to cope with the world shifting towards higher interest rates? Or is this going to force the central banks to essentially raise rates at a much slower rate or even start cutting them in the future? Because certainly the markets are betting that all of this is going to force central banks to start cutting rates going forward. And if that's the case, that raises big questions about the inflationary outlook.
John, just to add on to that, I guess what would regulators also, I mean, given that we're going to have lawmakers speaking with the representatives from the FDIC, Federal Reserve, of course, and then additionally the U.S. Department of the Treasury, what do you expect them to say about the subsequent acquisitions, but ultimately, I mean, I think it's fair to say fire sales that have had to happen just in order to keep some of these banks who they still have clients that they need to answer to and make sure that people have access to their funds. What do you expect them to say about the consolidations that have taken place thereafter? And if there is, to Jillian's point, more systemic risk that is still out there, what we should continue to expect on that front?
Well, I expect that they will probably hail this as a success. I think they're going to say, hey, look, we sold the parts of the failed banks that we could sell to other banks that can make good use of them. And just look at the markets, things are bouncing back. People are getting more confident in the banking sector. So all's clear. I think that I expect them to say that, although I expect lawmakers to kind of press them on that. As for like the broader contagion, I mean, or the broader risk of having underwater assets, that isn't in itself a problem. It's only a problem if you have to sell them. And I think the kind of broad and sort of rapid change in the interest rate environment over the course of the last year has baked a lot of that risk into the system. But it's really kind of investor confidence and public confidence that that kind of decides whether that's a problem or not. So I think they're going to try to just give reassuring messages and and try to paint this as a victory.
John, for those who are not familiar, American Banker covers the banking industry probably more closely than any other publication, right? That's what you guys do. So I'm curious from the bank perspective, what American Banker's reporting is finding, like sentiment amongst the banks, the level of alarm, and are we really seeing a bifurcation of that between the bigger banks and the smaller regional banks right now?
There's a pretty broad diversity of opinion in the banking sector about what moment we're in and what it means. I think there is still a decent amount of concern among smaller banks, especially smaller banks that have assets that they want to hold to maturity and don't want to sell, that they don't lose their deposit base. I think the concern is that if you're a depositor and you're kind of thinking about running, where do you run to? You run to a bank that you kind of know is too big to fail. Even though no banks are supposed to be too big to fail, everyone knows that's kind of not true. So, and what you're seeing is maybe kind of a hastening of a trend that's been going on for decades, which is consolidation in the banking industry, particularly at the smaller end. But that said, I think there's also a lot of this intervention was intended to sort of stop that and to kind of keep this from turning into a extinction event for smaller banks. And so as a result, I think people are still cautiously optimistic, I think is the way I would paint it at this point. And hoping that if there's any further problems that that rescue will be readily available to them from the government.
Jillian, within the turmoil that we've seen within banking, last week during our conversation, you also brought up the topic that we hadn't heard a while, or the phrase that we hadn't heard in a while, which is moral hazard. Do you expect that will have or should have a considerable portion of the discussion that takes place within the Senate hearing?
Absolutely. And the only thing that's worse than moral hazard is completely ambiguous moral hazard, that no one is able to predict where the boundaries of the moral hazard actually lie or not. And that, unfortunately, is where we are right now, because the reality is that for the last 12 years or so, not only have we had extremely loose monetary policy, free money, we've also had essentially a Fed put, an assumption that the Fed would always bail out the markets and institutions as needed. Now, the Fed has started to try and step back from that. It's been raising rates, it's running off the balance sheet. But the problem is, with something as we've seen around the whole issue of the FDIC protection of depositors at Silicon Valley Bank, what that episode has shown is that when there is a crisis or crunch, the rules that exist, and of course before SVB went down, the rules said you only got protected for the first $250,000 of the deposits, the rules will get ripped up. And so going forward, it's going to be very hard for the Fed to signal whether it's actually backing individual institutions or not, whether it's backing the markets. It's going to be hard for anyone to know what the FDIC rules are. And the fact that Janet Yellen herself, the Treasury Secretary, appeared to flip back and forth last week around that indicates the sense of confusion. So I definitely expect to hear Republicans in particular raise the question of moral hazard and the uncertainty about just how far the government is propping up the system or not going forward.
Yes, there's definitely some confusion around all of these questions. I'm sure they'll all be answered in the hearing tomorrow. No, they won't, but that's okay. John Heltman, American Banker, Washington Bureau Chief, and Jillian Tett, Editorial Board Chair and Editor-at-Large for the U.S. at the Financial Times. Thanks to you both. Appreciate it.
Thank you.
Turning now to our trending ticker, we're looking at Tesla. Shares are rising more than 3% on some positive commentary from analysts. Barclays saying the automaker could see a modest first quarter delivery beat, implying some upside to the stock and providing a catalyst for it. The analyst Dan Levy also says he expects additional price cuts, but that Tesla is better positioned for those reductions. So that's among others. I believe there's also an Adam Jonas note out on Tesla as well. Coming up, Russian President Vladimir Putin has announced his plans to place nuclear weapons in Belarus. We'll get the latest from D.C. next. Got a quick check of the markets for you now, sponsored by Tasty Trade. We've got stocks hanging on to gains here. The Nasdaq's gains fading a little bit, but on the whole really remaining fairly steady today, with financials in the driver's seat in terms of leading the gains today. Well, Russia's President Vladimir Putin announcing late Saturday that the Kremlin will station nuclear weapons in Belarus. He said the move would counter the United States' deployment of nuclear weapons in different European countries, and noted that Washington has nuclear weapons in Belgium, Germany, Italy, the Netherlands, and Turkey. So far, Poland's European Union Affairs Minister urged the West to stay calm over Belarus's nuclear weapons placement. For more on how the White House is responding, let's get to Yahoo Finance contributor Kevin Cirilli. Kevin, good morning. Good to see you.
Good morning, Julie. White House National Security Council spokesman John Kirby telling CBS News over the weekend that they do not believe that Russia is going to deploy a nuclear weapon in Ukraine based upon the intelligence reports that they have received. Now, NATO putting out a statement over the weekend saying, quote, Russia's rhetoric is dangerous and irresponsible. NATO is vigilant, and we are closely monitoring the situation. We have not seen any changes in Russia's nuclear posture that would lead us to adjust our own. We are committed to protect and defend all NATO's allies. So from the White House perspective, from NATO's perspective, right now, this is just a lot of irresponsible talk coming from Moscow.
Let's stay with the White House for a second. President Biden has approved a disaster declaration for Mississippi, granting federal aid to supplement recovery efforts that are already underway as well after tornadoes devastated the area. What more can we expect from the White House in response?
Search and recovery efforts still very much underway after these horrific storms devastated the region, leaving 26 dead and dozens more injured, and of course, hundreds more without power. President Biden declaring a state of emergency and assuring those folks impacted by these devastating storms that they will receive the federal funding that they need. FEMA, the president has said he's talked with the leaders of FEMA. He's talked with the governors, the local officials on the ground there, and assuring those impacted that they will not leave. The federal government will not leave until this situation reaches recovery.
Yeah, and indeed, it's quite a devastating situation. One more topic that you're watching there in D.C., Kev, Honduras, ending its more than 8 years of diplomatic relations with Taiwan, choosing to establish ties with China instead. What are the geopolitical implications for this new partnership? I mean, it's quite interesting as we see really geopolitical positioning around China and the U.S. as of late.
Well, three things. First and foremost, the Taiwanese are saying that this is just dollar diplomacy and that Honduras sold out to the Chinese Communist Party for $2.5 billion. Secondly, from China's perspective, they're saying that this is a part of a trend in the region of deteriorating support for Taiwan. Now in that region, Taiwan only has 12 countries. It was previously 13. Backing them. Now, thirdly, is the U.S. and the West totally rejects that characterization from the Chinese Communist Party. President Biden, Republicans, Democrats have all said that Taiwan is an incredibly important democratic ally in the region, and they've noted, as we should note, that President Biden has said that the United States would defend Taiwan economically, and there's been some question even about militarily. I do want to reemphasize that the United States Congress has passed bipartisan legislation that would modernize the Taiwanese Relations Act from several decades ago that would provide military assistance and in similar way that the U.S. has backed Ukraine, for example, as a result of Russia's invasion of Ukraine. So again, dollar diplomacy on display from the Chinese Communist Party, the Taiwanese pushing back against that. And they're saying that for $2.5 billion, this is going to come with strings attached. And they're using Africa countries as an example and an illustration of many African countries that had sold out to China. And as a result of that, now face incredible economic pressures as a result of their economic ties with China.
All right, Yahoo Finance contributor tracking all things domestic and international, Kevin Cirilli. Thanks so much for breaking this all down for us. Appreciate it.
Thank you.
Coming up, Elon Musk is touting Twitter's latest valuation, and it's far below the $44 billion price tag that he bought it for. Yahoo Finance's Dan Halley has the latest next. Twitter is apparently worth just half of what Elon Musk paid for it, according to a leaked memo from the company. Since Musk's takeover, the company has seen ad revenue plummet and employee headcount slashed by more than half. We're joined by Yahoo Finance's own Dan Howley for the latest here. Dan, like $20 billion is what it's worth now versus the $44 billion. What happened?
Yeah, less than half is what we're looking at here. And, it really comes down to the number of companies that seem to be working with Twitter as far as advertising goes, and just I guess where people see the company at this point. Twitter is still very popular among a certain set of the population. Celebrities, brands, journalists, thought leaders, people along those lines. But it's never going to be the TikTok or Facebook that it could have been, or maybe Elon Musk hopes it will be. But we're looking at this $22 billion $20 billion valuation versus the $44 billion valuation, and I really think it comes down to just not enough advertisers jumping onto the platform, and no clear direction as to where the platform's going. There was talk originally about Elon Musk turning it into an everything app, similar to what we have in China with WeChat. But now, it just seems as though it's kind of floating along. They're trying to get their sea legs. They're talking about raising revenue through subscriptions, how, you need a subscription to use two-factor authentication now. For logging in, you need a subscription. For the check mark, which is going to be reintroduced, and they're taking away check marks that were legacy check marks. So it just seems like there's all these strange ways that they're trying to raise revenue, but the main source is still advertising. And if they can't get people to jump on, then that's going to hurt them.
Yeah, and who knows, maybe at some point they can build it into an everything app and do all this stuff. It's a question of how many people hang around, I guess, in the meantime. There are also some reports, Dan, of Twitter's source code being leaked to the public. Can you talk us through that? Like, for those of us who don't know this stuff, what does that mean? What's the significance of it?
Yeah, so the source code is incredibly important because it's basically the basis for the app itself and the platform. So, you get access to a source code. You can, kind of find your way through it, potentially get vulnerabilities or find vulnerabilities and then exploit them. But it's also, copyright material. So this is, Twitter's own proprietary source code. So if it's going out into the public, then that's a violation. That's why it was taken down by GitHub, where it was originally posted by a account called Free Speech Enthusiasts. And so that's, a significant problem for a company like Twitter when the source code is put out there. It's not all of the source code. It was just portions of it. We don't know how much was taken, if there's going to be future posts of the source code. But, we're also looking at Twitter potentially putting out the source code for its retweets and things along those lines. That's something that Elon Musk had brought up, saying, we want to kind of get this out there. It's too kind of heady. We want to cut down on kind of the bulk in it. And so that's what they're going to do. But, this is just a broader issue, I think, and part and parcel of the problems that we're seeing at Twitter. They have thousands of a few thousand less employees there, and that really, impacts the business all around. We've heard stability issues when it comes to the servers. We've heard about issues with employee satisfaction, people who want to leave or don't want to leave or are being asked to leave, and then cuts that are just seemingly happening out of nowhere. So yeah, it can't be a great place to work right now. And I mean, if you're an employee and you're supposed to be on watch for this, you likely have your hands kind of everywhere trying to sort a way through it. So I think this is something that we may continue to see with the company.
One of the common responses from users that are on the platform is just, okay, he's made all these cuts. The platform still operates largely the same way that I expected. However, they might not have been kind of subjected to some of the hate speech that ran abound or ran amok on the platform thereafter. Some of those cuts were made and Elon Musk took over. So I guess the larger question is, what ultimately is going to change about the experience from Elon Musk's perspective to make people want to pay for access or to pay for a blue check or to some elevated type of experience, knowing that the delta hasn't been that different?
Yeah, I mean, I think that's the real question, right? Like, I'm not going to pay for a check mark. I don't care, right? I do want two-factor authentication. That's something for safety, but I don't care about a blue check mark. It doesn't say anything. You know, I think the problem with that, obviously, is what we saw previously when people were buying blue check marks and then, you know, going ahead and posing as other companies. That was clearly a problem for folks like Eli Lilly, where the price of insulin was discussed and it impacted the company itself and its stock price, you know, celebrities, things along those lines. So, you know, that's an issue, and it's a separate issue. But yeah, I don't see much changes as you're kind of alluding to, Brad, where, you know, this isn't a different platform. It's the same thing that I've been using. I have no reason to want to use it more or less, maybe less, just because, you know, I mean, Twitter is Twitter, and it's always been that way. But yeah, it's not anything particularly interesting to me. It's not TikTok where, you know, it's drawing these kind of, you know, interesting viral trends, or Instagram where you're seeing, you know, celebrities have these conversations or people sharing, you know, interesting educational things. It's just the same old Twitter, basically. And yeah, to get to a $250 billion valuation is where he wants to get it eventually. I don't know how you do that at this point.
I mean, you know, you just throw out a number and you make it, you know, that it must be real since he threw it out there, right? That's the goal. Dan Alley, we'll see. Could happen. Stranger things have happened, maybe. Thanks so much. Appreciate it. Coming up, we're going to check in with our executive editor, Brian Sazzi. He is live from Shop Talk in Las Vegas. He's got a lot of interviews planned. Look at him waving there. We'll talk to him in a minute.
Artificial intelligence, machine learning, all topics discussed heavily in tech in 2023. But now you've heard all the rumors. AI is coming for your job. It's going to steal your family. It's going to eat the food off of your dinner table. Folks, how much of this is actually true?
Generative AI is here, it's in everyone's palms, and it's not going anywhere.
To find out more, we went straight to the experts to discuss where technology meets culture and where the South met the Southwest.
We're here at South by Southwest. We're here in the Lone Star State. We're posted up on what is the most musical part of Austin, Texas.
Webster's dictionary defines AI as the simulation of human behavior in computers. Sounds harmless, right? But with the exploding popularity of generative chatbots like ChatGPT, many people are re-examining where they stand on the technological food chain. Ian Beecraft is one of the leading voices in deep tech and AI. His company, Signal and Cipher, teaches large companies about how to adapt to new technology. Ian says, we've only scratched the surface of what AI can do.
We are at the very beginning of one of the biggest revolutions in knowledge work in human history. And a lot of people look at this as a large step change in the way that we do our work. What we're doing is we're digitizing skills the same way that we mechanized physical labor in the Industrial Revolution. You're doing things at a scale, at a volume, and at a breadth that human minds aren't really capable of.
So will the rise of AI lead to job losses? And if so, why should we embrace this technology? We met with Gary Kasparov, the former chess grandmaster, famous for his series of chess matches against the 1980s supercomputer Deep Blue.
Every new technology in the past threatened jobs, actually destroyed jobs, destroyed industries before creating new opportunities. So AI is not an exception. Machines made us stronger in the past, made us faster in the past. Many jobs we're doing today, in my view, they are like zombie jobs. They're already dead, they just don't know it yet.
Okay, so far, our experts have not painted a particularly rosy picture for the future of mankind, so we went directly to the source. You know what they say, keep your enemies close. According to ChatGPT, artificial intelligence has the potential to greatly impact the future of humanity in both positive and negative ways. On the positive side, AI has the potential to improve many aspects of our lives. That doesn't sound too bad, but it goes on. One major concern is that as AI systems become more advanced, they may become difficult to control, potentially leading to unintended consequences or even catastrophic outcomes. Therein lies the concern, and why many in the tech industry are approaching AI with a good deal of caution.
People are getting freaked out that, hey, what is this thing? You know, can we trust it? I see both sides of the argument. And, you know, in some ways, there's a lot of opportunity, but on the other hand, we also have to be careful just with any technology.
That was Pulkit Agrawal, assistant professor of computer science at MIT. So instead of thinking about AI as a replacement for human beings, according to Pulkit,
We should think of AI as a tool. Like the invention of the PC, AI may actually improve our work and make humans more efficient in performing our day-to-day tasks.
If an AI system can look at, say, CT scans and make a diagnosis, is it going to replace a doctor or not? I would say no.
While the possibilities for AI may seem limitless, it could be the key to unlocking the potential of the human brain.
The Terminator and Matrix and other things that brainwash the public. Machines cannot dream, so we should dream. Yeah. We should think how we can actually cooperate with machines. I believe there's the opportunities are absolutely endless.
The country's major retailers, from Foot Locker to Walmart, are in Las Vegas this week for the huge annual industry event called Shop Talk. Yahoo Finance's executive editor Brian Sazi is there at the Mandalay Bay in the center of all the action and hitting some tables later, I hear, allegedly on the streets. But for right now, he's talking to all the big retail CEOs about the latest business trends, the impact of slowing economy and the banking crisis, much more. Brian, what are you hearing over there?
Well, as they would say, Mr. Smith, no comment on whether I will be hitting the tables and the slot machines later. Nonetheless, you're right. We are here in Shop Talk, Mandalay Bay, Las Vegas. Over 10,000 people here at this conference, close to 300 senior level executives here, mostly in the retail space, but a lot of focus here on technology. You walk behind me here, there's a large installation center, hundreds of demos and installations, really giving consumers and other people at this conference a good snapshot in the future of retail, seeing a lot of artificial intelligence. That is being talked up a lot. Also, believe it or not, despite it being an old technology, mobile pay, PayPal's out there on the floor as well. Now, speaking of all this, I actually got to catch up with Pinterest CEO Bill Ready. He's very focused on trying to make his platform more shoppable, as if you go onto a Pinterest, you see an outfit that you like, you can click through and buy it. But he's also very focused and keeping his eyes on what's happening at TikTok and what may not happen at TikTok. Now, I asked him his views on that platform and what he thought would happen to his business if TikTok was banned in the US.
I think with social media broadly, this question of, how do you make sure that it's additive and not addictive? How do you make sure that people feel better after having spent time with it is really important. And we think that's our role to play, because there's been lots of research that has shown that as people spend more and more time on social media, they have rising rates of anxiety, rising rates of depression. People feel worse after having spent time there. And that very same research consistently shows that after spending time on Pinterest, people feel better after time on Pinterest. That's not an accident, that's intentional.
Now, Bill, he declined to say whether if TikTok were to be banned here in the US, if they would see a pickup in users. But of course, you would have to think if there is no TikTok, a platform like a Pinterest, a Snap, and of course, Instagram and Facebook theoretically would see an improvement in users. But again, right now the focus for Bill Ready at Pinterest is making that platform more shoppable and continue on what he has been telling me, focusing on a more positive social media experience on Pinterest.
That is really interesting stuff, Saz, that is, that deliberate and that they're trying to sort of make that a differentiator. Taking a step back, you wrote this morning in the morning brief about the sort of disconnect seemingly between maybe some of the consumer-facing companies, the CEOs, and their vibe, and what we're seeing in the broader economy. I mean, I don't know if that's just sort of comes with the territory of being at a conference where they're all talking to each other, but like as you get further into it, what is the sort of tone like?
Well, you're right, Julie. He wants to tell media that, the sky is falling and we're going to miss our quarter. No one, but it is interesting. Like I wrote in the morning brief newsletter this morning, there is still this optimism out there amongst CEOs and executives. I'm feeling it here. I asked Bill Ready over Pinterest, Pinterest CEO, if the ad market winter is starting to thaw. He did tell me ad demand is choppy, but I did sense a slight shift in tone from Bill relative to when we talked last month, maybe a little bit of an improvement. Now, I also talked to Chewy CEO Sumit Singh. We'll have that interview in the 11 o'clock hour. He said consumers are pulling back on discretionary items, but overall his business continues to do very well. I would venture to say when I talk to Foot Locker CEO Mary Dillon a little bit later on, she will come out positive as well in her business. Maybe as she should. The sneaker business continues to do very well, in large part because of purchases by Brad Smith.
That's very true. Actually, it tracks tracks very well on probably my own individual line within their own balance sheet. I trust that for sure. Brian, make sure you stay nourished out there, get some Uncrustables. If they're good enough for Sam Burns, they're good enough for us too, us mere mortals. Everyone, coming up, one of the most tumultuous March Madness tournaments in history. How did this impact sports betting? We'll speak to an analyst from Oppenheimer. That's coming up next.
Quantitative tightening, QT. Now, this is something that you may have heard in the mix over the last several months. Let's talk about exactly what this is. This is when the Fed shrinks its balance sheet. How they do it, they let some of the securities mature and fall off the asset side of the balance sheet. They do this when the economy is in overdrive and inflation is running very hot. Certainly something that we have seen play out over the last several months. So let's talk about exactly what the Fed's balance sheet is too, because when you talk about the fact that they are rolling off some of those securities, you might think, wow, that's a heck of a lot of money. Well, the Fed's balance sheet, $8 trillion. $5 trillion of that is treasuries, and more than $2.5 trillion of that is mortgage-backed securities. Right now, QT is capped at $95 billion a month. So how does this impact you? QT could pressure bond prices, which then pushes up yield, so affects everything from bank lending to the mortgage market and also to you, the investor.
Let's get a check on what's going on in markets here. We have the Dow coming down off its highs a little bit here. The Nasdaq actually is going to the nearly unchanged level, and S&P also coming down off of its highs here as we get into this session's just over an hour old now at this point. So interesting here that we are seeing that little bit of a change. I'm also watching the bond market closely today. Yields are more steady here today, about 3.5%, but a big move upward in yields on the day as we see a little bit of stability Treasury come back to the market here. We've got yields higher, but the dollar lower. U.S. dollar index down by about 0.1%, which is interesting to see that kind of action. And we talked a little bit earlier about oil prices moving back up here today. But still, if you look over the longer term, we are seeing them at relatively depressed levels. That's the year-to-date chart. Looking at the heat map here, as we try to figure out, okay, why are we coming down off the highs of the session? Let's look to the sectors here, because these are the groups that are now holding back the gains here. We've got communication services, we've got real estate, and we've got tech that are all showing a little bit of weakness. Questions continue to swirl around commercial real estate valuations in particular, and whether we are going to have to see various other companies that hold commercial real estate mark down that real estate. Is that going to be an issue for some of the banks and other types of financial firms? We continue to zero in on that. And as we talk about tech also being a weak performer here, you've got more red on this screen now. Google in particular, Alphabet standing out to me with a decline of nearly 2%. Let's talk about another company that we're watching. That is Rivian. Its production facility in Normal, Illinois, forecasting 2023 production below analyst estimates. Now the company is looking to move part of its manufacturing and engineering team to the facility in a bid to speed up production. That's according to reports from the Wall Street Journal. Yahoo Finance's Pras Subramanian has the details on what's going on here. Pras?
Hey, Julie, how you doing? So I'm actually about 150 miles outside of that Rivian plant. I'm here in Chicago, Illinois, not too far away from there. But yeah, this is a big deal, with the Journal reporting that the Rivian wants to move that manufacturing engineering staff to their Illinois factory. They want to speed up production, and this would entail moving staff from around the country, from places like Michigan, Illinois, Virginia to Normal, Illinois. Not sure how many people would actually make the move, the Journal's reporting, but that for those who won't do it, they're offering severance. So they'll basically have to leave the company if they don't want to do this move and help out at the plant. So, what's at stake here is basically, like I said, if boosting efficiency, making more trucks. They barely missed their 25,000 production target goal of 2022. Looking at 50,000 here, doubling that, maybe more potentially at Normal for 2023. The goal is here to make these trucks cheaper. They're losing a lot of money, spending a lot on CapEx. And even CEO RJ Scarin just talked about it isn't capital efficient to operate the plant the way they are right now, because they're just not making enough vehicles to sort of spread across those costs.
And Pras, what's at stake for Rivian if it falls behind in the EV pickup market?
So Rivian was one of the first out of the gates here with an EV pickup, right? And then the Ford F-150 Lightning joined them. But what's happening now is you're going to see the Silverado, the EV, come out this year, as well as Tesla's Cybertruck. And Tesla has proven that they can actually make EVs at scale. So we'll see how fast they can ramp up that production. In addition to the Ram pickup coming next year. So a lot happening from a competition point of view. They might lose out on their first mover status if they can't keep up production and make enough of these trucks, which are, by the way, more expensive than the other sort of work trucks that Chevy and Ford will make.
All right. Yahoo Finance's own Pras Subramanian, tracking all things Rivian and, of course, getting around point A to point B. Pras, appreciate it. Another round of March Madness games was wrapped up this weekend as the men's tournament heads into the Final Four and the women's tournament concludes the Elite Eight tonight. But with the men seeing the last #1 seed get eliminated in the Sweet 16, how has this impacted this year's betting? Oppenheimer senior analyst Jed Kelly joins us now. I mean, Jed, do we even have anybody better than a top 5 team seeded that's made it into the Final Four here? And has there been any impact?
Well, I mean, typically you generally get 2 #1 seeds that make it. Now you can argue UConn back in December was probably the best team in the country. It was one of the best teams in the country. Then Big East started and they started to lose a couple games. But has this impacts betting? It's been a pretty profitable year for the sports books, especially this year relative to last year. I think if you recall, the sports books had tough holds in March of 22. This year's been much better. There's a couple of things at play. One, last year you had St. Peter's. A lot of the public got on that story in the Sweet 16. And then number 2, you had a lot of heavy favorites, blue bloods, make the Final Four: North Carolina, Villanova, Kansas, and Duke. This year, obviously, I think it's the first time ever no #1 seeds made the Elite Eight, and it's the first time since 1970 that we have 3 teams that have never made a Final Four before.
And when you get that kind of activity, does it tend to increase or decrease the betting interest, right? I mean, if people if their brackets get blown up early, do they just sort of give up and not place further bets?
Well, I think it's interesting. I mean, I think the first and second round, they were, the first round had record ratings, right? So I think you had a lot of interest. We also have more states. It's also an extremely engaging event to bet on. So I don't think it impacts the handle as much. Certainly if people are losing more, they tend to bet less, but the games have really been exciting. I mean, Kansas State, Michigan State was great. You had UCLA, Gonzaga. Last night you had Miami and Texas, where Miami came back and won. So we've had a lot of exciting games despite none of the big name programs being left.
And so, I mean, yeah, this is, of course, leading up to the NBA Finals. This is kind of the March Madness is the precursor for some of the commencement of what else is yet to take place in basketball. So this could be even just kind of a trend setting or a wave setting, even, if you will, going into what the betting could look like for the next 2-3 months, even for some of the books out there. What are we anticipating for that to really net out at as we move into this next quarter, and even for some of the companies that you're covering?
You see, that's been like the difficulty is typically what you've seen is sports betting's really popular into the Super Bowl. You have a little bit of lull, then you have it popular into March Madness. What the sports books haven't been able to do as much is really increase the betting post the Masters, right? Like you do have interest around the NBA, MLB starts, but you do see a lull, call it from end of April to Labor Day. Now there's a lot more going on. People are out more. So that's one of the things that we haven't really seen the sports books do is sort of drive that engagement into spring, into football season. So, we do have more states that are legal. So now you can actually see the sports book do more brand advertising around sports betting. You're seeing FanDuel and DraftKings do a lot of that. And then, can they do some sort of interesting, developments around product, around maybe like same game parlay that can bring people in and keep them engaged until football season.
When you look at DraftKings specifically versus some of its competitors here, how's it doing? I mean, does it have a leg up as sort of an online betting native company? Some of its competitors have bought other sort of native companies, but I just wonder how it ranks.
Right now, DraftKings is number 2 in online sports betting. Flutter's FanDuel is clearly number 1. I mean, they're probably generating a 12% hold on their total handle. DraftKings is probably around like 8.5%, 9%. So FanDuel has a big edge there, and they're allowing them in the higher yield is allowing them to just do smarter targeted promotions. So you're seeing Flutter's FanDuel clearly take a number 1 lead in sports betting. However, DraftKings is doing better than them on iGaming, and we still think DraftKings has better customer acquisition competencies. But FanDuel's clearly number 1, DraftKings is number 2, and then it's BetMGM number 3. But what you're seeing is the land-based players pull back and leverage some of their omni-channel capabilities in regions that they're strong. You see BetMGM is really strong in Michigan, but they're not as strong in New York because they just don't have that land-based presence.
Jed, while we have you, some of the most recent news out this morning is that the NFL is going to be looking to put forward a vote, and that's going to be centered around how they have in-stadium sports books open, and perhaps even on game days, keeping them open as well. I mean, is there a net effect that you believe in terms of a windfall that some of the companies you cover are going to be able to see from this?
It'll be slightly, it won't be that big of an impact. I think it'll help with branding. The one thing to remember is you can still bet on your phone in the stadium, right? So, why would you go to a ticket counter if you can just open up your mobile device? The other thing too is that when you're in the stadium, it's actually real-time action, so you can bet live. So I don't think it has a huge impact. I think it's just better for the brands. You can just do more branding, and maybe you might be able to acquire some more customers on some at the sportsbook promotions, but we don't think it's a huge deal.
Jed, good to catch up with you. Oppenheimer senior analyst Jed Kelly talked to us about sports betting. Thank you.
Thank you.
Coming up, let's check on the major indices as we head to the break. And stocks pretty much where we were, where we checked them a little bit ago. The Nasdaq, a little change now as stocks sort of come down from their highs of the session. Well, we've got the wonderful Rochelle Akufo joining us live in our New York studio to continue coverage in our next hour. Normally she is remote. Today she is here. Welcome, welcome.
Thank you.
So talk to us about what you're watching, what's coming up on your show, how you're spending the week here in New York, what restaurants you're eating at. No, I'm just kidding. We don't have to go quite that far.
Well, Freeman's is where I'll be looking to eat. But it's ironic because as I'm here in New York, we've got the congressional hearings on the failings of Silicon Valley Bank and Signature coming up this week. Now, these are bipartisan hearings. People want to get a bit more clarity on, the bank failures, what this means for regulation. Was there anything that Dodd-Frank rules could have done, the existing guardrails in place? So really looking to get more clarity. I'll be interested to see if this actually adds to some of the confidence, because obviously banks seeing a rebound today, both regional and the big banks. Could something be said that could perhaps throw off some of that confidence? We've seen Treasury Secretary Yellen and Fed Chair Powell trying to sort of calm those nerves. And I'm going to have two guests coming up in the show. One is going to be really focusing on the hearings, as well as any sort of potential contagion that we're not really paying attention to. And another guest is going to be talking about some of the VC implications. Are they as confident, or should they be as confident right now? Because he's saying there could be some warnings down the line that they should be really looking for at the moment and not so comfortable right now.
Interesting.
Wow. All right. So you got a packed hour coming up ahead.
Yes.
And a lot more coverage of the regional banks here as well, too.
Yeah, most definitely. And then this week we're going to get the actual hearings and find out if that is going to be the case, that we'll get more regulation or not. So looking forward to all of that, Rochelle.
Thank you.
Live in living color here in studio.
Yes. All right. Stick with Rochelle. She's got you for the next hour of trading. We will be back tomorrow with much more as well. And we'll also get some restaurant reviews from her when she eats in all the places in New York.
I will eat my way through the 60s.
All right. Good plan. We'll give you some recommendations.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's what I'm watching this morning. A busy week kicks off with a banking rebound leading stocks higher as First Citizens agrees to buy parts of Silicon Valley Bank. We'll look ahead to the Senate hearings over the SVB crisis and whether or not all this is just the calm before the storm. And where is the tech sector heading in the aftermath of the collapse of one of its key lenders? We take a temperature check on the global venture capital space with Ray Wang. This on the day that Jack Ma resurfaced in China and gave markets a brief boost as well. And the U.S. labor movement churns on. United Auto Workers members hold their first ever direct election, sending their president to the exit with high-stakes negotiations on the agenda later this year. We discuss the new leader and check in with the wider movement. But first, let's check in on how the major indices are faring. A mixed picture here at the moment. We see that the Nasdaq, the only one in negative territory, down there just slightly, though, about 0.1% there. We see the Dow there still having some gains, although seeing some of that buying action slowing down almost 0.5%. Similar situation for the S&P, they're down about 0.2% as well. Let's also check in on the Treasury market. Usually we see that flight to safety when there's uncertainty, so a reverse here as markets seem a bit calmer today. We see there the 5-year up just slightly there, what about 3.8%. The 10-year also seeing gains there, 2.8%, and the longer-term 30-year up about 1.5%. Well, bond market moves, Apple as a bellwether, and the Fed's balance sheet. We'll be watching these and other stories all this week. Let's get the latest with Yahoo Finance's own Jared Blickery. Hey, Jared.
Hey there. Well, I thought we'd go to the Wi-Fi Interactive and just show what I'm looking at this week. There's a lot to look at and arguably a little more, but we're going to start with the bond market and the 10-year treasuries is what I'm watching first. And this is a proxy for the banking sector, what the Fed is going to do, and then we'll get into some other stuff like Apple and what the Fed's balance sheet is actually doing. But first, I'm going to go to the 10-year treasury note. And this is a 1-year look at the yield on that. And what you might observe is that over the last, let's say, 6 months, and this is a very imperfect drawing here, but we've been in a trading range. And when you drill it down to the last 3 months, something really interesting happened. At the beginning of February, we popped above 4% for the first time in months, and then we immediately sunk below. And then when we came down to this previous support level of about 3.4%, we dipped below that, and then we popped back above. In fact, we popped back above very strongly, which is where we are today. 10 basis points, not a small move. So what this tells me is the move is the range in the 10-year Treasury note is really between 3.4%, which is down here, and 4%, which is way up here. Anything in between, just kind of noise. But the direction should tell you which asset classes are going to be favored more. When yields are rising, that tends to weigh on growth stocks. So not surprisingly, when we saw this big decline here, that was favoring the mega cap trades, which brings me to my second thing here that I'm watching. That is Apple as a bellwether for tech stocks. So let me get back to our charts. I'm going to show you what's been happening at Apple. It has been moving very productively, but I think it has hit some potential longer-term resistance. Now, here's a 2-year chart. I'm going to draw some trend lines here, and it is right smack up against this upper one here. And then if we can also draw some upward sloping trend channels in here, forgive the amount of technical analysis, but it's what I do. And suffice to say, we are up against some pretty formidable potential resistance. Now, Apple could spike higher to 1.65. You can see it's hovering just below 160 right now. But I think absent a major catalyst, Apple's move probably done for the meantime, especially since it's unlikely, we were just looking at 10-year T-note yields, those would probably have to fall a bit farther to support the Apple trade. Now, finally, the third thing I'm looking at, a little bit more esoteric. You're not going to necessarily find this ticker on the Yahoo Finance ticker site, or excuse me, Yahoo Finance site here, but the Fed's balance sheet is something that tells us a few different things. Now, at 1 year ago, this was the height of basically the Fed's balance sheet before they started reining it in, before they started raising rates aggressively. That began in March of last year. Shortly thereafter, the Fed's balance sheet peaked just short of $9 trillion in assets, and it shrank all the way down to $8.3 trillion. Now, with the recent banking crisis, the Fed has opened up a new long-term lending facility. It also has, it's also lending from its deposit window, and with this line right here, you see this line spiking? It has already clawed back 2/3 of these losses that took about 9 months on its balance sheet to wind down. So, In the short term, we still have some signs of, I guess, flight to safety here, and that would be the Fed's balance sheet. And we're probably not going to see some huge moves into the big tech mega caps like Apple, but watch that 10-year T-note yield as it rises here. If it climbs to the upper end of its range, probably going to be a hamper on those big growth stocks, maybe favoring those cyclicals, Rochelle.
Something to keep an eye on. Certainly people wondering if they should hold on to their cash or get into some of these bigger trends. Great stuff there, Jared Blickery there for us. All right, well, some other top stories that we're watching. The Senate to hold its first hearing on the collapse of SVB and Signature. This as First Citizens acquires the remnants of Silicon Valley Bank. Meanwhile, TikTok's ban from U.S. government devices looms. Here with a wider economic look is Tom Simons, Jefferies economist. Good to see you, Tom. So obviously a lot happening this week, a lot of data that the Fed will be watching closely as well. What are the real standouts for you this week?
So later in the week, we'll be getting jobless claims, initial jobless claims applications for unemployment insurance. And this is weekly data. We get it every Thursday. So it's sometimes easy to kind of look past. But at this point, it's really our best real-time indicator of what's going on with the economy. And in terms of trying to sort of assess the fallout from all this stress in the regional banking sector, our expectation is that it's going to work its way first through small businesses. And small businesses have been the biggest driver of job growth throughout this cycle. So if we're going to see that stress translate into stress in the broader macroeconomy, I think that the first place we're going to see it is seeing layoff announcements really translate into actual layoffs and then people applying for that unemployment insurance.
And also, obviously, seeing these tighter lending conditions. What should people be aware of in terms of the domino effect of that?
Well, it's acutely concentrated with SVB in terms of their lending capacity for startups and tech firms and that sort of thing. As SVB, is wound down and now it's going to be acquired by another bank that is not necessarily, doesn't necessarily have the same sort of expertise with that type of client and with that type of activity in the region. I don't think that you're going to see the same sort of flow through with lending. Also, the bank, as we just saw with the Fed balance sheet, there's a lot of credit that's been extended to banks, but it's much more expensive than it was before all this stress sort of started to accumulate. So I believe that to the extent that there is continued lending, it's going to get more expensive for small businesses. They're going to be operating in an environment that is not the same sort of nominal growth environment that we had in 2022. It's going to be much more challenging. And as I said, it's just going to be much more expensive. There's very little, expectation that they're going to be able to continue to hire the same way that they had before.
So then how much is riding on the jobs data that's coming out? Because obviously you have a very tight labor market. The Fed has had to worry about financial stability plus inflation as well. What are the expectations there?
So it seems like expectations are that they're going to kind of continue to trend sideways. We've seen very, very significant layoff announcements from big tech firms since November of last year. Multiple tens of thousands from Amazon and Twitter, et cetera. And yet, when you look at the jobless claims data for the last several months, it's really been almost dead flat. And there's a couple of reasons why that might be. It could be, packages for, letting people go. It could be that they're finding a job really quickly afterwards. But my sense really is that they're not letting as many people go as they say. Essentially, they're making the announcements to try to appease stockholders, but waiting as long as possible to actually let people go because they struggled so much to find these people during 2022 and during the expansion. So I think we're running to the end of that. I think that it's been easy to sort of look at how that went in the past and assume that it's going to continue. But as credit conditions continue to tighten and economic prospects continue to weaken, I think that there's just going to be little else in terms of options for these companies to try to save some costs. Thus, we will see an increase in layoffs. The question, of course, is does it come this week? It may, because we're now 2 weeks away from what was the collapse of SVB. We could start to see the ramifications of that in this more small cap tech sector, but it remains to be seen.
And Thomas, what about global catalysts that you're watching? I mean, we saw the ECB pushing ahead with rate hikes, but then you also have this hope that people had for the Chinese economic rebound as well. How is that influencing what we're seeing in the US?
Well, it is. I would term it as hope, just like you did, in terms of looking at what's going on in China, because it seems like that's been a theme for growth expectations for the last six months or a year. and it really hasn't come to fruition just yet. I think that the U.S. is more insulated from global factors than it has been in the past. I'm really much more concerned about this issue with the banking system, not so much in terms of continued failure, but just as banks find their way forward, how much less likely are they to be lending? We've already seen a lot of trending tighter lending conditions since Q3 of 2021. We're already essentially at levels that are consistent with a recession in terms of how tight lending standards are. I have to imagine they're going to get tighter still from here, and that overwhelms most of what's coming in from overseas, I would say.
We're certainly keeping an eye on that. Thomas Simons there, thank you so much. Economist at Jefferies, thank you for joining me this morning. All right, turning now to some trending tickers that we're watching. We're taking a closer look at crypto. Now, Bitcoin and its contemporaries could see a boost in emerging markets as a way of hedging against bank instability. CNBC reporting on its use in Africa, where it's used by the unbanked and the underbanked to carry out daily transactions. Cryptocurrency is also getting a second wind as bank instability forces customers to take a hard look at methods of holding liquidity during a bank run. All right, coming up, taxpayers may be on the hook for roughly $90 billion in Silicon Valley Bank securities and other assets that were not included in the sale. We'll discuss next. Silicon Valley Bank became the largest bank to fail since the 2008 financial crisis in recent weeks. Now, the sudden collapse rocked the banking sector, creating ripple effects in global markets and leading investors to draw numerous comparisons between SVB and the global financial crisis. Though some experts note that Silicon Valley Bank's collapse is more company-specific. For more on what distinguishes the two events, as well as the outlook for taxpayers who could be expected to foot the bill for SVB's unsold assets, let's get to New York Times business investigations editor David Enrich. David, thank you for joining me this morning. So, of course, we're used to seeing these comparisons now at this point between what we saw with the 2008 financial crisis. What are some of the more distinguishing features when it comes to SVB and Signature Bank's failures?
Well, as people have mentioned ad nauseum at this point, these were specific to interest rate risks, and both banks being woefully unprepared for something that I think many people saw coming a mile away, which was that rising interest rates were going to diminish the value of some of the bank's assets. And to me, this is something that is, scary in the moment. There is some fear that this is going to spread to other banks, but this is a far, far cry from what we were seeing in 2007, 2008, early 2009. And these are problems at relatively small banks in the grand scheme of things. And there's not been any signs, at least in the US, that the major banks, the ones that are really key to the stability of the financial system, are suffering any sort of run the way SVB and Signature were.
And to speak to that uniqueness, I mean, 94% of SVB's deposits were uninsured, as were 90% of deposits at Signature. Yep. Certainly not the norm by any stretch of the imagination. How much of this, though, is the psychological aspect of it? How much is that still lingering? We are seeing still regional and big banks at least rallying today.
Yeah, well, we've seen this kind of go back and forth over the past couple of weeks. There'll be a day of relief, then there'll be a day where things get a little more pessimistic, bordering on panic. And as you said, the problems that made Silicon Valley Bank and Signature Bank so susceptible to these sudden shifts in confidence, or the fact that they had so many uninsured deposits, their liquidity position therefore was really, it was not, the deposits were not sticky, to use industry parlance. And they were on the far extremes of the banking industry overall. There are a lot of banks, though, that have what I think many people would consider to be an over-reliance on deposits that are going to be more susceptible to just rushing out the door at the first hint of panic. But at the end of the day, banks are, their fortunes hinge on the public having confidence in them. And I think that this is one of the crucial differences between now and 15 years ago, is that there's been so many efforts to stabilize the banking industry and fortify it and make sure that, their capital and liquidity positions are much stronger. But I think it's going to be the odds of serious crises of confidence toppling major banks are a lot lower than they were 15 years ago. That's not to say they're zero, but they are a lot lower, I think.
And we obviously have the Senate bank hearings coming up this week. Questions about what regulators could have perhaps done. Did they drop the ball? And if some of the existing guardrails and protections under Dodd-Frank could have prevented these collapses. But what are you going to be watching for here?
Well, this just reflects my bias as a journalist, but I love the backstory of these things. So I'm going to be curious to hear just any narrative detail. I don't think that's what investors are going to be looking for. But I think there's going to be some real questions of accountability, not just for the people at these banks, although they definitely deserve it, but also the regulators that clearly, especially I think in the case of Silicon Valley Bank, appear to have been kind of asleep at the switch. And there were the issues that brought that bank down, I think, for most industry experts and people who are closely following the economy and the financial system, should not have been surprises. And yet you had regulators at both the Fed and in the state regulator in California not really ringing the alarm bells, at least not nearly as loudly enough as they apparently should have, at least in hindsight.
And I know something else people might be watching for, wondering whether or not the taxpayer might be on the hook for this roughly $90 billion in SVB's securities and other assets that weren't included by that sale to First Citizens. Now, we know that President Biden, when it came to the initial rescue of the banks, was saying, look, this isn't something that will fall on taxpayer shoulders. But what about this remaining $90 billion? Can he make that same guarantee?
I don't know if you can make that guarantee. I do think that there are. Look, there's a bunch of the balance sheet that needs to be unwound gradually. And obviously, a lot of the securities on the balance sheet have lost a substantial amount of value. The longer you hold it, the greater the odds are that maybe the assets regain some of their value. And look, but a lot of the losses that the FDIC risks being exposed to, both with the remaining stuff on the balance sheet and in part because they struck these kind of asset price guarantees with the buyers of both with Signature and Silicon Valley Bank. A lot of those losses, if they are borne out, will be borne not by taxpayers, but by the FDIC Deposit Insurance Fund, which is not being paid for by you and me. It's being paid for by fees that are imposed on banks based on the riskiness and size of their deposit bases. So I don't think this is likely to be a huge taxpayer bailout, if to the extent that it affects taxpayers at all. And I think there is definitely some risk that taxpayers will be on the hook for a bit of it, but these are not huge numbers. And again, at least not compared to the bailouts we've seen back in 2008, and even in the more recently and with the pandemic era bailouts of big industries like the airlines.
If anything, might be perhaps more expensive as the lending conditions get a bit tighter. Might see some of those costs passed on there. Yeah. I do want to just quickly ask you about Deutsche Bank. I know that you've followed their rise and the scandals attached to them because their name came up as the potential next shoe to drop in light of Credit Suisse's fallout. Yeah. But what is your thoughts on that in terms of would Deutsche Bank be too big to fail, and is these concerns about Deutsche Bank being next, would they be overblown?
Well, Deutsche Bank is definitely too big to fail. There is not a chance in hell that the German government or probably the ECB would let a bank of Deutsche Bank's size and kind of prestige go down. I'm not sure how well-founded these fears are, to be honest. And I think Deutsche Bank, look, it's a problem child and has been a problem child for a very long time now. And I think it's a natural place when investors go looking for the next bank to go down after Credit Suisse. Deutsche Bank is just probably going to be on the tip of everyone's tongue. It certainly was on the tip of my tongue when people started asking me what might go down next. And that's I think, in part a reflection of its legacy, its history of really terrible problems. The bank is on much stabler footing than it was 5 or 10 years ago, for sure. That being said, it is still a giant bank with a lot of legacy problems on its balance sheet. And I think that makes it vulnerable in times when there's a crisis of confidence. But again, I think this is more than anything a reflection of the fact that if you ask anyone who's been paying attention to European banks over the past 5, 10, 15 years, the worst bank on the continent, historically, that has been Deutsche Bank. And so I think it's a normal, natural, kind of automatic place for people to look for the next sign of trouble.
As you mentioned, they're not quite as poorly positioned as Credit Suisse with its own headaches and scandals as well. New York Times business investigations editor David Enrich, thank you so much for joining me. All right, checking here on the markets, sponsored by Tasty Trade. Still a mixed picture for the major indices. As you can see there, the Nasdaq still having a little bit of extra losses there as we head into this 11:30 hour. We see that it's down about 24 points. The Dow, though, up about 150 points, about 0.5%. Similar territory, we're seeing the S&P still in that same range it was earlier, down about 0.2, up about 2.2% there. Just barely, though, up about 7 points. All right, coming up, the US government's deadline to remove TikTok from its devices is approaching this week. We break down what to expect as the clock is ticking for the talk.
SVB hearing.
Major economic data.
And some heavy hitters reporting earnings.
It is a busy week in the markets. Here's what you need to know. For the first time, members of Congress will grill top banking regulators over the collapse of Silicon Valley Bank and Signature Bank. Expect leaders from the Fed, FDIC, and Treasury Department to testify on Tuesday and Wednesday as lawmakers try to get to the bottom of why the banks failed. Wall Street will be watching this week for the latest round of economic data. How is the overall economy doing? We'll find out with the latest GDP report, along with inflation and housing numbers. And big-time market movers Walgreens, Carnival Cruise Line, and Lululemon are primed to post their quarterly earnings. We'll get a good look at the consumer with these reports. Yahoo Finance will break down all of these stories.
TikTok watches the clock. The US government's deadline to remove the social media app from its devices is approaching this week. But in Europe, where that government's deadline passed on March 20th, European Parliament ministers are finding the apps too hard to quit. Here with more, Yahoo Finance's Dan Howley. Hey, Dan.
That's right, Rochelle. We're seeing reports that some of these parliamentarians are keeping the app or see the app as a means to communicate with a younger generation of voters. And so they will continue to use them either on their own devices or some other means, but not on their official devices where they're supposed to be getting rid of the app. And this is something that you might see here in the U.S. as well. The app is banned from being used on people's phones who are in the military. Different states have banned the app on different official devices, but it doesn't say anything about personal devices. And so there are some members of Congress, at least, that are pushing back against a ban. We had Alexandria Ocasio-Cortez kind of put out her first TikTok defending TikTok itself, saying that, you know, this is a leap forward that we're not ready to make, that they haven't done enough investigation. There's no clear evidence that there's any wrongdoing on China's part when it comes to TikTok or Americans' data. So we'll probably continue to see this kind of back and forth approach between some people who do think that the app is truly a threat to national security, and others who see it as a means to get in touch with the younger generation and get their voices out there, especially as we start pulling into the election season.
I mean, you figure if you're trying to get, especially to the younger voters, that's where you're going to find them. You're going to find them on TikTok. So understandably hard to quit. Dan Howley there, thank you for that update. All right, now time for today's chart of the day. BofA's fund manager survey from March reveals investors are bullish on cash and bearish on U.S. equities as an asset class. Now, this comes as banking fears continue to drive investors to safe havens on the heels of the collapse of Silicon Valley Bank. For the month, investors were most bullish on cash, emerging market equities, and alternative investments. After equities, they were most bearish on discretionaries. Well, let's continue the conversation on China's tech sector with a look at its sometimes testy relationship with the Chinese government. Jack Ma back in the spotlight for his return visit to China. This even as he keeps a distance from business after disappearing from public view. Joining us now, Ray Wang, Constellation Research Principal Analyst and Founder. Good to see you, Ray. So first want to start with Jack Ma's return here. What does that signal? We know that China wants more private business on board.
Well, they've had to have Jack back. Without Jack in the area, I think a lot of people were wondering if the private enterprises were going to be supported, and having the biggest and most popular figure out in Japan, hiding out for the last year or so, was not a good image.
Indeed. I mean, but when you look at where tech is headed, especially when we look at that BofA survey, a lot of people overweight in cash, really pulling away, though, from tech and some of these U.S. equities. Give us the lay of the land and what's happening with tech sentiment right now.
I think it's actually a little bit different. I saw the fund manager report you put up there, but tech has gone through a reset, right? Interest rates have gone up. We've seen that affect valuations. The valuations basically then drove in to see what was happening with earnings. Earnings were down and everybody decided to put in the job cuts because they had overhired, right? But even when we look from 2019 to where we are today, most of the tech companies are still up 20 to 25% in hiring, but they had really overhired, over anticipating where the market was. And then there's been cuts in R&D. But what's been going on with the banking crisis, it's basically led to a flight to safety. And so startups are under a cash crunch massively. The IPO market is pretty much dead, right? The banking crisis basically put liquidity on hold, and the VC liquidity is also another issue. But what's going on is there's a flight to Matana stocks. Why? Because there's large cap, high volume, safe, and consistent double-digit growth rates. They've got strong cash balances on sheets. And of course, there's a big revolution in the AI space where data going forward, the companies that have the data, that has the networks, are going to be in a good position. And so if you look at the Nasdaq, it's up, right? We're talking about a pretty healthy up case where we're looking at somewhere it's up about 14%. I don't know where the market is now, but it looks pretty flat. And that's about a $7.8 billion market cap for the top 6 stocks.
And so, Ray, for people who aren't familiar, Matana includes Microsoft, Apple, Tesla, Amazon, Nvidia, and Alphabet. And we know that that was the replacement for FANG stocks. Can Meta get any love, though, in this environment, the F that was in the FANG stocks?
The Meta may come back. I think what we have to see at Meta are a couple of things. If you look at their valuations, it's below $1 billion, right? That's been a huge cut. And it's mostly because of the investment towards the metaverse and the lack of growth on subscribers and ad revenue. But maybe Meta will come back. But they are in a good pace, especially if you're looking at a rebound in terms of where they are, but not as a index where the Matana stocks come into play.
And obviously, we've been hearing a lot about generative AI and this sort of race to be first and to be best, even though obviously still a lot of glitches to work out. But you noted that Microsoft, Google, and Amazon are using generative AI to lift their cloud business. What are the expectations there?
Well, there's a lot of anticipation that this boom in AI is going to use a lot of compute power. And that means anyone that's in that space requires more compute power for AI to happen and for the storage of data. Microsoft, Google, and Amazon are the 3 biggest in terms of the public clouds, but there are also other winners. NVIDIA with their GPU chips play a big role in terms of where AI is headed. And there are other companies that have done really well in terms of building very good cloud infrastructure, like Oracle, for example, has done a good job. There are applications in the world of C3 AI that's done a good job. And even Adobe, if you look at what they're able to do, not just in their creative cloud business, but also in their experience cloud and digital experiences overall. And so those are companies that are poised to do well in this AI boom. Those companies that don't have an AI play are going to be left out in the cold in this next round.
You mentioned NVIDIA. Obviously, a lot of talk here about what happens with US and China in terms of tech competition there. Chip makers under some pressure. We saw that the Commerce Department recently announced some of these guardrails that if you're receiving some of this funding, it does limit your ability to expand into China, your capacity out there. What is the smart approach here then? If you're a chips investor, but you're sort of stuck in the middle between what the US and China might do?
I think you have to bet on the fact that AI is going to create demand. NVIDIA, AMD are going to be in good spots. TSMC, given the plants that they're building, that diversification of where chips are going to be built is going to play a big role in the future expansion. You're not going to see that right now in this cycle, but in the next chip boom cycle, you'll see that as AI consumption is up. That means data centers are going to buy more chips, and that means other companies are going to need much more compute capacity.
And Ray, I always watch you on Twitter. You're always at all the conventions, getting really a pulse of what investors are doing and what founders are doing. What are some of the top 3 themes that you're seeing as you go about your travels?
Yeah, so one of the most interesting things that's been going on is, as we've been talking about ChatGPT and what's happening with AI, we're starting to realize how much data we need and how much compute power that's going to be required. There's a lot of interest right now. We're in the beginning of that hype cycle, but what we're going to see over time is that data sets become important and companies will start hoarding data sets or creating unique data sets. We often joke, right? Topgolf was bought by Callaway, and potentially what could be happening is Callaway now has the biggest collection of really bad swing data. Now, what could you do with bad swing data? You can make better golf balls and better golf clubs. And that kind of unique data sets are going to be there. And that's an exponential advantage compared to other companies. These are companies that we call data inc businesses. And you're going to see more and more of these data inc type businesses pop up. The second thing is really around automation and where we're going to head. And we're going to see a lot of human augmentation for quite some time because there's a lot of information that actually has to be processed. And what that means is, right, we're going to get to error rates of about 9%, 3%, 2%. And so a 98% accuracy is great when you're not doing anything that impacts humans or causes healthcare issues, right? And we're going to be searching for that last piece. And that human training with machine data is going to come, it's going to be very, very important. And then the last piece I think that we keep seeing across the board is really the need for some level of AI ethics, right? Where we can actually see the algorithms, that they're transparent. We can explain bias when it happens, and we can prevent it and reverse it when it's not supposed to happen. And of course, we're going to have more human training. And if you want to actually make sure everything's okay, you start with a human and you end with a human so that the machines don't take over.
The machines don't take over. That is always that ultimate fear. Thanks to movies like Terminator. Well, thank you very much, Ray Wagner, Constellation Research Principal Analyst and Founder. Always good to see you. Thank you for your time. All right, coming up, first, Citizens Bank announces a deal to acquire a portion of SVB, but have firms fully begun to feel the impact of the banking crisis? We discuss next.
SVB, plays a critical role in the entrepreneurial ecosystem of this country, but the level of innovation hasn't stopped at all. There are really exciting companies across all industries, and especially you mentioned OpenAI, where we were the first venture investor in that company. That has led to a lot of excitement in the generative AI space. We've always been at the forefront of sustainability and renewable energy investing, and we're seeing lots of activity there as well. So that activity hasn't slowed down at all. The bank provides a lot of services, but in terms of the entrepreneurial ecosystem, that's as vibrant as ever.
Last week, venture investor Samir Kaul joined us with a positive outlook for startups and the VC landscape in the wake of SVB's failure. And just last night, First Citizens Bank announced they're acquiring a portion of SVB. But our next guest says firms have yet to fully reckon with the impact of the collapse. Joining me now is Sam Yagan, co-founder and managing director of Corazon Capital. Thank you so much for joining me today. So in terms of the sunny outlook there that we got from Samir, are you also seeing that reflected?
I think there's a big difference between what's happening in startups and how those startups get funded. And I think he's exactly right that the founders in the startup ecosystem are as innovative as ever, and there are great companies that are being built as we speak. The problem that SVB brought is that those companies are not going to have as much access to capital. They're going to raise much less money at much worse valuations, and those founders are going to be much more diluted as they build those businesses.
So then how much of a difference now does it make with First Citizens Bank here stepping in with that buyout of large parts of SVB?
It's a great question. Are they going to be active in the startup ecosystem? SVB over decades built a reputation and relationships as being the single most active player in the banking category for startups. First Citizens doesn't have that same track record. They've obviously acquired the bank. What is their posture going to be toward these relatively risky startup investments? I don't know what they're going to do, and I don't think they've really said what their position is going to be.
And it doesn't sound like you believe the worst of the repercussions when it comes to venture capital and sort of venture debt is behind us. What do you think does lie ahead then?
There is effectively no venture debt market right now. What had already been a slowing market, the SVB collapse just slammed the brakes. We are seeing almost no deal flow. What does that mean? That means an entire asset class for startups is currently unavailable. There is effectively no venture debt. So where you might have gone out to get a loan to fund your inventory or your growth, you now have to go get very expensive equity from venture capitalists. Now, the venture capitalists themselves, I think, have not yet fully had their day of reckoning in that they're still carrying those valuations from the heyday back over a year ago, and they have not fully priced into their own balance sheets and their own numbers what the new market reflects on those valuations.
So then some of the rebounds that we're seeing at the moment for regional banks and for the major banks as well, should we sort of take that with a grain of salt then at the moment?
I think when you think about the impact on the startup ecosystem, they're pretty disparate, meaning the regional bank stocks and this acquisition of SVB, how those will impact startups' ability to access venture debt, I think are totally unrelated. And but again, we have all these founders building great businesses. And the question is, how are they going to capitalize their businesses and what new players are going to step into the void that SVB's collapse has given the market?
And so then in terms of solutions, is it about more government regulation or more government intervention when it comes to stemming some of the longer term risks and contagion when it comes to venture debt?
I think with the government stepping in and securing all the deposits, I think they certainly gave the market the stability that it needed. I think when it comes to venture debt itself, that's much more a question of how much risk are these banks willing to take when it comes to backing these startups that don't have the track record that a lot of the public companies have.
That certainly did put SVB in a very unique position here in that community. A big thank you there, Sam Yagan there, Corazon Capital co-founder, for joining us this morning. All right, new leadership for the United Auto Workers Union is promising a new era for workers. Newly elected President Shawn Fain has vowed to take a, quote, more aggressive approach in dealing with employers. Joining me now with the latest is our very own Danny Romero. Danny, what are the expectations here?
What a victory lap for Shawn Fain, who is now the new president of United Auto Workers Union. And this is a critical one for them as they head to that negotiating table. But not only that, but how did Shawn get to that presidential seat? Well, for one, this was the first election that was open to all union members. And not only that, it was a really close battle against his opponent, Ray Curry, who was the former head of the union. And not only that, there are some reports that Shawn had some of his allies in the executive board. So that could have steered a little bit of the direction in favor to him. But not only that, this was also a runoff election from November's vote. There was a lot of discrepancies and scrutiny against those results. But not only that, we have to put it into perspective, right? What the union really wants is they want change. And to give you some context, before this election with Shawn Curry, let's talk about him. Ray Curry was appointed president in 2021 because federal investigators found a lot of corruption within the union. So they booted the former president at that time. So already two presidents prior to Ray Curry, have been in jail. They're serving time due to this corruption within the union. But Shawn's whole campaign, like you said, is taking that being confrontational in that contract negotiations, and especially being very persistent when it comes to wages and benefits. So we'll have to wait and see how this all plays out. But not only that, Shawn has been in the union for over nearly 3 decades. So he definitely knows what he's talking about.
So then in terms of what this means for some of these Detroit automakers, some of these legacy brands, what sort of timeline are we looking at here for negotiations?
Well, negotiations already started January 5th, but the contracts end September 14. And their biggest sticking points revolve around their 2-tier wage system, as well as their benefits. And not only that, they really want to win back some of their cost living adjustments. And job security is their number one thing, because you have to put it into perspective. A lot of these car companies are moving and shifting to electric vehicle production. So they really want to be safe and secure with that.
Certainly be interesting to see how this plays out, because we know, as we've said, he's going to be taking a more aggressive stance here. So automakers will be keeping an eye on that. Thank you so much, Danny Romero, there for us. All right, well, let's also take a look at what's happening when it comes to supplier of pets, Chewy. They topped earnings expectations last week. Yahoo Finance's Brian Sozzi catches up with their CEO to discuss the company's outlook for the remainder of the year. Stick around. Online pet supplier Chewy topped earnings last week as net sales grew over 13% year over year. Yahoo Finance's Brian Sozzi caught up with the company's CEO Sumit Singh to get his outlook on the previous quarter and what they have in store for the year. Take a listen.
So first of all, we're super proud of the earnings. We delivered, nearly 14% growth year over year. A profitable year. Chewy for the first time is net income positive. Record EBITDA at 3% and over 20 million customers. So by all measures of record, team has a lot to be proud of. And I can tell you 23 for us is going to be very much, stay focused, keep the discipline, flawless execution, customer acquisition, net addition growth, and a lot of innovation on the bend here.
How did you reach profitability? Because I know that it has always been a focus by your team, and Wall Street always wanted to see it too.
It's not, stuff like this doesn't happen overnight. I mean, we've been working for this a number of years. If you look at the mission statement internally to Chewy, a couple of years ago, the mission statement we adopted was we were going to get big fast, but we will also get fit fast. And so what that is it's building operating fitness into the routine of the organization, but then it's investing, to drive towards profitability. It's using your scale to take cost out of the system. It's continuous improvement that essentially makes you better, in your processes, in your infrastructure that allows you then to kind of deliver that scale much more efficiently. And so, if you look at our gross margins, they've grown from 20% coming out of 2018-19 levels into 28% is what we closed last year. Our SG&A, we took in roughly $150 million of cost, in wages and benefits and just sort of enduring the pandemic. And now with our automation benefits kicking in our fulfillment centers, we're taking it all back, right? And so all of this adds up, and it's helped us kind of continue to drive towards profitability, and here we are.
Talk to us about these automation efforts. It's something that I picked up on the past 2 earnings calls, and you seem to be talking about a little bit more. What do your facilities look like right now?
Yeah, so these are part of our broader supply chain transformation initiatives. What you have to realize is Chewy has gone from $2 billion coming out of 2017 to $10 billion coming out of 2022. When a pure play e-com company like ours grows that fast, that big, you have to transform your supply chain a couple of times along the way. And so, up until 2017, we were fulfilling product. Now I'm back to the operations environment. We were fulfilling product out of our legacy, mostly manual environment. And so, I looked at that, the team looked at that, and we said, look, if we are to truly improve safety and ergonomics, if we are truly to improve productivity, if we are truly to lower our cost structure, we will have to invest in second generation automated fulfillment centers. And on the back of that, we dramatically innovated, invested in what you would call automated storage, retrieval systems, state-of-the-art shipping sorters, state-of-the-art technology that allows us to pick, pack, ship, etc. And having now been 3 years into the journey, we're seeing improved safety, we're seeing improved productivity, and lower cost structure. This past quarter, we flew through roughly 30% of our volume through these automated sites. We have 3 of them at this point, at 20% lower cost structure. And that just adds up.
Given your ability now that you've taken these costs out of the system, you're now getting ready to expand overseas, internationally. What can you tell us about this initiative? And can you push back a little bit on what we've heard from Wall Street, that this is now a multi-year investment cycle for Chewy?
So great questions, by the way, both of them. So first of all, we are super excited. If you review our mission statement, to be the most trusted, convenient destination for pet parents and partners everywhere, it's that word everywhere that was always there. So this was a matter of when, not if. And so, we've worked hard over the last few years to strengthen our fundamentals. What does that mean? Build operating fitness into the routine. Get the culture where we want it to be so that we are not distracted. Get our infrastructure and technology to the point where we can essentially reach outside the United States. Plus, don't forget, pet parents, you and me, we treat our pets like family, and that doesn't change whether you're in the United States.
Animals eat better than me. Full and fair disclosure, their food is amazing.
That doesn't change. Pet parents are more the same than different, and we believe the brand is resilient outside the United States. And so with that in mind, yes, we've announced our foray into our first international market. We haven't announced what that is. We will do so in the upcoming May earnings call, per se. But we're super excited about it. And in terms of the investment curve, look, these are strategic investments, and we are long-term oriented. Had I said to you at the time of 2019 when we were IPOing that, hey, I would be 3% EBITDA profit, in a matter of less than 4 years, you would have been like, get out of here. Because at that time, we were negative 6.5% EBITDA margins. And yet, our long-term EBITDA margin target is between 5 and 10%. And we are steadily, continually, marching towards that profit target. And launching something like international doesn't take us away from that.
In the U.S. market, going back to the U.S., it's been a weird time. March, we're talking about a banking crisis and consumers pulling back a little bit. What are you seeing in your data? Are you seeing a more cautious shopper?
We absolutely are when it comes to categories that are discretionary in nature. So consumables and health that make up over 80% of our sales remain pillars of strength. Consumers aren't trading down, and they aren't sacrificing their pets' needs for their needs or otherwise. Where they are, of course, cautioning is in discretionary spend. And so what you're seeing is that the dollar that used to go, towards a plethora of toys for the pet, now, they're buying toys in limited quantity. But, the core input, Brian, is actually tied to pet household formation, which right now is slightly subdued relative to its historic growth rates. But in 2008, 2009, when we saw a recession, this was exactly what happened. And it took a few quarters to correct itself. And once these macro inputs correct themselves, discretionary spend comes back in line.
When do you see active customers reaccelerating?
Yeah, so when you look at our growth in gross ads, we are actually adding customers at a faster clip than we were pre-pandemic. What does that tell you? It tells you that the current that was towards online has continued. Pandemic was high tide. We're sort of in low tide right now, coming out of the pandemic, but the current's still strong. And so our, main commentary has been around working through the massive pandemic cohorts that we acquired, and we are now in the last leg of managing churn through that particular cohort. And so it's just about digesting the mathematics, and what we've guided to this year is positive net adds.
Well, our Brian Sozzi will continue his chats at Shop Talk later today and throughout the week with executives from Foot Locker, Pinterest and Ulta later today, so stay tuned. All right, coming up, some big moves in the crypto space this hour. We break it down for you next. Some big moves in the crypto space this hour. The CFTC suing the world's top exchange Binance and its founder CZ. And there's a ripple across the sector with Coinbase and Marathon dropping. Yahoo Finance's David Hollerith joins us with the latest. Hey, David.
Rochelle, so this has been filed in a federal court in Chicago, and it's the CFTC against Binance, which is unusual in that we usually see these lawsuits come from the SEC. The SEC's made increasing effort to regulate the sector. In the CFTC complaint, it has accused Binance and its founders, CZ, of incorrectly shirking obligations to properly register with the agency. And in particular, they name Bitcoin, Ether, and Litecoin as commodities, which is obviously interesting, as we've sort of seen in this dialogue that regulators don't always coalesce in what they say. And the SEC has said more or less that everything except Bitcoin could be a security. So potentially, obviously not good to see the largest cryptocurrency exchange filed a lawsuit, but there's been a lot of talk about this ongoing about Binance's relationship to U.S. customers. It's not supposed to operate in the U.S., but then this kind of silver lining where the crypto sector could actually see more regulatory clarity from something like this. So interesting lawsuit. We're still digging into it.
And certainly after we saw the fall of FTX, a lot of eyes looking at Binance, wondering what else was going on there. So in terms of what this means then for the broader industry, how much of this is Binance specific versus industry-wide?
Yeah, that's a good point. I mean, it's definitely Binance specific in that how it'll affect their customers and in their transaction flows. The complaint also points out that they've exaggerated transaction volume. And Binance for the past year has talked about wanting to sort of settle with U.S. regulators on a number of fronts. So it's not good for the company. But again, I think that we could see more clarity in terms of regulation for the sector, just in terms of which crypto assets are deemed securities and commodities. And that has been the big thing.
Certainly be keeping an eye on that and what happens with the price of crypto as well. Dave Hollerith, thank you so much. Right, well, before we go, let's give you a final check of the markets, see how they're faring. Still a mixed picture here. We see the Dow under pressure, Apple and Microsoft weighing on the Dow there, but still in positive territory, up about 160 points. S&P, as we look at some of the sectors there, we have financials and energy topping the sector action. That's also pushing it up there, up just barely, though, about 0.1%. Tech-heavy Nasdaq there being dragged down, though, about 0.6% there. Tesla, the red bit of green in a sea of red there on the Nasdaq. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.